Candidates, welcome to the lesson. For those of you who are joining for the first time, we have been answering questions from the April 2024 sitting. So far, we've done question 1 and question 2. Today, we're going to answer question 3. Question 3. It's my hope you have the question papers which we had shared in the WhatsApp group. Make sure you print the papers if you have not printed, so that when you appear in these lessons, have the hard copy. Okay. Now let's begin. Question 3A. Explain the following option trading strategies. Explain the following option trading strategies. Roman 1, bull spread. Roman 2, bear spread. Roman 3, covered call. Covered call. 2 marks each. Now these were brief questions on option trading strategies. The first one is bull spread. Bull spread. Now, before we explain the bull spread, first of all, what is a bullish market or a bullish investor, and who is a bearish investor? That by understanding, first of all, a bullish investor, we will be able to easily understand the bull spread. Now, first of all, in the context of financial markets, bullish refers to an investor or a market sentiment that expects prices to rise, and therefore a bullish investor is optimistic. A bullish investor is optimistic about the future performance of a particular share or stock or market or asset class. They believe that prices will rise and are likely to buy or hold on to assets in anticipation of gains in future. That is a bullish investor. Is one who expects that the prices will rise in future, and therefore is likely to hold on to an asset, hoping that when the prices increase in future, is likely to gain. Now, having understood a bullish investor, then what's the meaning of bull spread? Now, bull spread, as the question suggests here, is an option trading strategy. Okay? Bull spread is an option trading strategy. All right? First of all, it is an option trading strategy, and is used when an investor expects a moderate rise in the prices of the underlying asset, and it involves buying and selling 2 options of the same type, but with different strike prices. So that is the meaning of bull spread. Then Roman 2, we have the bear spread. The bear spread. Now, to understand the bear spread, we ought first of all to understand a bearish investor. A bearish investor. Now, bearish is the opposite of bullish. It is the opposite of bullish. You recall we say that a bullish investor is one who is optimistic about future performance of a particular stock or asset. But we are now saying a bearish investor is the opposite of bullish. And bearish refers to a negative or pessimistic outlook on the future performance of a particular stock, market, or asset class. So a bearish investor believes that prices will decline and is likely to sell or avoid buying such an asset in anticipation of such losses. That is a bearish investor. And therefore, what is a bear spread? Now, a bear spread is just like a bull spread. It is an option strategy that is used when an investor expects a moderate decline in the prices of an underlying asset. And it involves buying and selling two options. And the two options are of the same type. You understand? That's the meaning of bear spread. Then Roman 3, we have covered call. Now, a covered call is also an option trading strategy where an investor holds a long position in an asset and sells call options on that same asset in order to generate income from the option premiums. And that strategy is used when the investor expects the underlying asset to have very little or no price increase. That is the covered call. That is the covered call. Now, that is part A of the question, 2 marks each. Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, two assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But you may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's now work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That's clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line. are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. And are the E. Okay, so that's the first column. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4, beta negative 0.25. E, 13% plus 4, the beta there is 3.25. So these are the required rate of returns for each security. Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return 26. So that's it. How many marks? How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now, to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. We have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This you are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Can I hear from you? Anna says overvalued. It is above the expected. So it is overvalued, correct? Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. And required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, In this case, in the first case, the expected in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now, with that knowledge, what do you think of security B? Is it overvalued or undervalued? Security B? Overvalued. Jackie says overvalued. That is correct. Security C? Overvalued. Security D? B is overvalued. D? 12. This one is correctly valued. Correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks. Part C says Madarax Limited is an e-business company that trades solely over the internet. In the year 2023, the company made sales worth 15 million shillings. All sales were on 30 days credit to commercial customers. Extracts from the company's most recent statements of financial position relating to working capital are as follows: trade receivables, trade payables, bank overdraft. Additional information. 1. In order to encourage customers to pay on time, Madarax Limited proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. Number 2, it is expected that on average 50% of customers will take the discount and pay within 30 days. 30% of customers will pay within 45 days, and 20% of customers will not change their current paying behavior and will pay within 60 days. 3. Madarax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases over the last year was 540,000 shillings. 4. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Madarax 150 shillings to place, and the holding cost is 0.24 shillings per unit per year. 5. Madarax Limited has An overdraft bank facility charging interest at the rate of 6% per annum. Assume 365 days in a year. Required, Roman 1, calculate the net benefit or cost of the proposed changes in trade receivables policy and comment on your findings. 6 marks. Roman 2, using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable. Comment on the assumptions made in your computation. 6 marks. Roman 2 now is the other side of the coin. This business is selling on credit, but the business, is it buying on credit? Look at Roman 2 says, using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable. Now let's analyze this one. This one is debt management of debt, management of debtors. In Roman 2, in answering Roman 2, we will rely on additional information 3. Look at note 3. Madrax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases over the last year was 540,000 shillings. 4. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Madrax Limited 150 shillings to place, and the holding cost is 0.24 shillings per unit. Now, you can see, candidate, now this question is testing your knowledge on inventory management. Inventory management. Here we are talking about stocks. So it was 2 in 1. The candidates were tested on management of trade receivables and management of inventories. Do you realize that? It's important for you to realize that. If someone will ask me, which topic is that? It's good to think that way also. This is inventory management. Still working capital management. And working capital management is an investment. Working capital is simply the investment in inventories, trade receivables, and cash. Okay? Now, what is the formula? What is the formula? I'll give you an opportunity to answer that one. Every problem has a formula. Every problem can be solved in a certain way. What is the formula in determining whether the bulk purchase discount offered by the supplier is financially acceptable? That is what is required. So what is the formula? This is the question. This is the question. Acceptable. That's why I'm using the term acceptable. Determine whether the bulk purchase discount offered by the supplier is financially acceptable. To determine, then you need to calculate the net benefit of accepting the bulk order. So what is the formula? That's how you should be thinking all the time. This is the question. In our previous question, this was the question. So this question, what is the answer? How do you arrive at this question? How you arrived at the answer is what we call formula or approach. And every question has its own unique formula in business. There are those that may be direct, like what someone is saying here, EOQ. EOQ has a standard formula. Here we are not to calculate, what you are calculating is not a standard formula, but you need to come up with your own formula. And your own formula can only be accurate if you have understood the question. So why students have a problem is setting the wrong question. Because someone sees orders, holding costs, then one thinks what is required is the EOQ. So you say EOQ is equal to. But you see the question is not on EOQ. And the examiner required, if the examiner was to be direct, because your examiner is not always direct, because the examiner needed to just say, what is the net benefit of accepting the bulk order? That is a direct question. Because the examiner sometimes does not ask questions directly. Look at how the examiner put the question. It says, determine whether, it's a very long thing, determine whether the bulk purchase discount offered by the supplier is financially acceptable. It's not direct. So that's why you need to take time and check what is the examiner. Don't look at the details in the question. Sometimes start by reading what is required. You understand? Yes. Now that you've understood, give me the formula. And if the examiner had asked the question this way, what would be your answer? Please, let me get your answers. Vincent says, bulk purchase using discount, less purchase without discount. So when we began candidates, I told you, when you see the word net, you are most likely comparing two things, adding things and subtracting. You cannot get net when you only have one variable, the way you are saying. You see, net benefit is equal to cost of discount minus. Look at the other one. Net present value is equal to present value of debenture minus. So this is net. What is the net benefit of accepting the bulk order? What is the net? So we are comparing two things. And it's almost similar to management of debtors in note number 1. We are here dealing with policies. This was trade receivables policy. This one is inventory policy. Inventory policy. And this policy, there is an existing policy and there is a proposal to change the policy. And the proposal in relation to bulk purchase discount. So if you are to get the net benefit of accepting, please, then you are comparing the current policy and the proposed policy. You are comparing the two. Okay, to get the net benefit. It could be a benefit, could be a cost. You understand? So anytime you see net, NPV, net benefit, you are comparing 2 or 3 things. Okay? So we are to calculate or determine whether the bulk purchase discount offered by the supplier is financially acceptable. So we have the cost of the current policy. This is equal to cost of the current policy minus the cost of accepting this bulk order, the proposed policy. That is the cost of inventory policy after bulk discount. Sorry. So the net benefit of accepting the bulk order will be equal to the cost of the current policy, the cost of the current inventory policy minus the cost of inventory policy after the bulk discount. We need these two things. Then we determine the net benefit. So let's now calculate the cost of the current policy. I saw some of you say order cost, something like that. Maureen says number of units bought divided by the units discounted. I know all of you are doing management accounting. Help us with your knowledge in management accounting. Cost of inventory. Candidates, cost of inventory. Let's begin with the current policy. Cost of inventory, we know, will be equal to the purchase price of the inventory. The purchase price when purchasing, you are likely to incur ordering costs plus ordering costs. Then when you go to the supplier, you will incur ordering costs, like you need to make a call, you need to send invoices, you may need to visit. All that involves ordering. There are examples of ordering costs. You make a call, you have an accountant who is preparing orders, you pay that accountant. So the cost of inventory includes the purchase price of the inventory, but related to purchasing, there are other associated costs like ordering costs. Then after you have ordered, the goods have been brought into the business, then there are also other costs which we call carrying costs, holding costs, storage costs, the same thing. Holding costs. Before you sell, these items have to be stored somewhere in a store. That store, they are, if depending on the materials or the goods that you purchase, you may need refrigeration, you may need to have a, if you are in a country where insecurity is very high, you need to have a security officer with dogs or guns, all right? You need to have surveillance, CCTV, storage, holding costs. You need to have someone preparing the store, cleaning the items, holding costs. So cost of that's the cost of inventory. So this will be the formula for that and that. I know you are management accountants. Give me the purchase price. Give me the purchase price. I've given you the formula. Abraham says 540. It's 540,000. What is the ordering cost? Ordering cost. Use your management accounting knowledge. Give me the ordering cost. Ordering cost. And it has to be the annual ordering cost. Ordering. Abraham says 150. 150 is per order. So how many orders were made during the year? You multiply by the 150 to get the annual ordering cost. It is like buying motor vehicles in Kenya. The purchase price is lower than the taxes. Kenyans buy, the purchase price is lower than the amount you spend in ordering. You see, your ordering cost is 4.5 million per year, and the purchase price for what you've ordered is 5 140. It's abnormal, isn't it? But is common in developing countries. Yeah, 150 times 15. I think that makes sense. How did you get 15? That is 15. Abraham, 15,000. Let me look at the question. Madrax currently orders 15,000 units. That is not the number of orders. Those are units. And that is units per month. But we have to calculate the ordering cost per year. The 15,000, you need to be very keen. The 15,000 is units per month. We need to calculate the number of orders. Number of orders. That tells me you've not done management accounting, or you have not done that topic. I expected you to move very fast on this one. Step number 1, put down the formula. Then you see this one is not in the question. You need to work it out. Cost of the current, you need to work it out. In working out, you see the items that you can pick from the questions. Others have to be worked out. So again, we need to have a working for annual ordering cost. What is the formula for annual ordering cost? To get the formula for annual ordering cost, when you are given the cost per order, then you only require to calculate the number of orders. Then multiply with the cost per order. Number of orders will be equal to the annual demand divided by the quantities ordered during every time the amount the customer orders, there is that amount that is ordered. Okay, and in this question you are given the amount. Madrax orders 15,000 units per month. Okay, so the annual demand, this we multiply by the cost per order. Let me put the formula down. The cost per order. CO, cost per order. Now to calculate the annual demand, we are told that Madrax orders 15,000 units per month. So it will be 15,000 units per month. How many months are in a year, please? How many months? How many? 12. So the numerator is the annual demand, the number of units ordered during that year. 15,000 divided by the times 12. We divide by the number of items that are ordered. If the company is operating under what we call the EOQ, if it is economic order quantity, then we'll have it. But we've not told anything to do with economic order quantity. But I see some of you are saying economic order quantity formula. Abraham, we are not, there is no economic order quantities here. Okay, we do not have economic order quantities. But we are given the number of quantities that are ordered. It may not be economical. You may need also to check what is the meaning of economic order quantity. It is not economic order quantity. We are just told Madrax orders 15,000 units per month. So you get the total number of units ordered in a year, then you divide by the 15. This will give you the number of orders. That is the number of orders. Then you multiply by the cost per order. What is the cost per order? The cost per order, 150. Each order costs 150 times 150 shillings. That is the ordering cost. You understand? Are you understanding? Are you understanding? It was easy, but not easy. Hmm? So Abraham, how much is it? Abraham says 1.8. 1.8. It's 1.8. 1.8 million. So this is 1.8 million. We add the holding cost. And it has to be the annual holding cost. Annual holding cost. Give me the annual holding cost. What is the annual holding cost? Why dividing 15? Why dividing 15? We are dividing 1500. 15,000, not 15, it is 15. This is 15,000. It is not 15, but 15,000. We are dividing the total units that were ordered during the year. And every time an order is made, 15,000 units are ordered. So if you divide the total demand with the quantities that are ordered every time, you get the number of orders. Then you multiply with the cost per order, that is 1.8 million. You thought it was to be divided by 30. You should not think DML. You just follow the information provided. 30,000, I think it is in relation to note number 4. Note number 4 is something else. Note number 4 says the supplier has offered a 2% discount. You see, that is something different. We are calculating the annual ordering cost under the current policy. Do you get the difference? Emma, so the answer is 1.8. Yes, the answer is 1.8. The answer is 1.8. DML, now that you got it, give me the holding cost. Annual holding cost. Emma is asking, is it 1800 or 1.8? I think it's 1.8 million. Emma is 1.8 million. 1.8 million. Because it's 15,000 times 12. Is it 1.8 thousand? It's 1.8, not 1.8 million. I think, Emma, you are right. That is 1,800. It's 1,800, correct? This is 1,800. You divide this, you get 1,800. Because this is, I think, 12 times 150. There are 12 orders. One order is 150 shillings. That is correct, Emma. Then give me the annual holding cost. Annual holding cost. If you have covered that topic, how do you calculate the annual holding cost? You are just going to use the same concept, the same razor blade. Please use this razor blade. It is almost the same razor blade. In Swahili we say wembe ni ule ule. Wembe ni ule ule. Omiti, half Q. Give me the answer. Half Q. Yeah, you are right. Half Q. CI, where C is a C. What is CI? I prefer CH. Carrying cost. It's not CI but CH. Carrying cost or holding cost. Or HC. Yeah, HC or CC. Not CI but CC. Holding cost. Which language have they used? Holding cost. So use the same. You have an idea. Now give me the amount. You see how things are related. It's like we are doing management accounting. 31,250. How did you arrive at 31,250? What did you divide by what? Because we have the holding cost per one. Look at note number 4. Is it number 4? Yes. Each order costs 150 shillings to replace, and the holding cost is 0.24. 0.24 shillings. That is the storage cost, or the holding cost, or the carrying cost. So to calculate the annual holding cost, you will multiply the units with the 0.24. What is the answer? Annual holding cost. Someone says 1.8. Omit 1.8. 1.8. So the formula, for the sake of those who have not done management accounting, we are going to have it Q. We are going to take Q over 2 times holding cost per unit, which is equal to the 1500. 1.5 we divide by 2 times 0.24, which is equal to 18. So this is 18. So what is the total cost of inventory? What is the total cost of inventory? Total cost of inventory. Total cost of inventory. What is the total cost of inventory? We have the purchase price plus the ordering cost plus the annual holding cost. What is the total? $543,600. 543,600. 543,600. 543,600. Is that true? 543,600 minus cost of inventory under the new policy. Please confirm. That's the answer. So let us calculate the purchase price, ordering cost, holding cost under the new policy. Under the new policy. Is that true? Is it 543? Yes. Can I rub the board? Can I rub? You've done that, so we don't need this. We'll use the same formula. Formula is the same. Annual ordering cost under current policy and old policy is the same. Now give me the ordering cost under the current policy, where there is bulk discount. What is the ordering cost? What is the ordering cost? We know the annual demand does not change. The annual demand is constant. So this annual demand we know is constant. It's 1500. Is it 1500? Yes, times 1200. 15,000 times 12. That will give us the annual demand. We divide by the quantity. Under the new policy, what is the quantity? Under the new policy, what is the quantity? So what is the order quantity under the New policy. It is written there in note number 4. The supplier has offered a 2% discount for orders of product of 30,000 units or above. How much is it? 30,000. So what is the answer? Ordering cost. 30,000 is the quantity ordered. Get the number of orders, then multiply by 150. Number of orders, then multiply by 150. It is true, this is 30,000. Under the new policy, this company will not be ordering 15,000 units, to be ordering 30,000 units because there is a bulk order. You understand? It has gone up. It's 30,000. So this will give us the number of orders. Then cost per order is 150. Okay? So the formula here is still the same. Annual ordering cost, someone? Annual ordering cost. Is it your internet that is slow? Irene says 900. Yes, 900. Ordering cost 900. This is 900. How about the annual holding cost? You get the number of units multiplied by the cost. Holding cost is 0.24. So give me, yeah, you are right, 6 orders, DML, that is 6 orders, times 0.24. Is it orders? No, it's not orders, it's just 6. Q over 2 is not orders, DML. Yeah, it's 6 orders for annual ordering cost, correct? But you are now working on holding cost. You are right, 6 orders. Which is equal to 900. Now give me the annual holding cost. Annual holding cost. Kevin says 3600. Yeah, 3000 divided by 2 times 0.4, 3600. 3600. How about the purchase? The purchase price. So this is how this is calculated. 3000 divided by 2 times 0.24. That should give you 3600. We've done the annual ordering cost. We've done the holding cost. Give me the purchase price. 30,000. Give me the purchase price. So this should be 30. For those of you who are taking notes, let us be accurate. This is 30,000. 30,000. We need to calculate the purchase price under the new policy. You are not supposed to think. The information is given and it's direct. We read that in note number 4, the supplier has offered a 2% discount. Okay. So what is yes, 98%. So what will be the purchase price? DML, you are right. There are many ways of calculating it. So 98%. What will be the purchase price? It will no longer be 540 because there is a discount of 2%. The purchase price before the discount is 540. So the purchase price before discount, the purchase price before the discount is 540,000. And there is a discount of 2%. So 540,000 is represented by 100%. So less 98%. We just multiply this by 98%. That will give you the purchase price. It is less 2%. So if it's less 2%, then it's 98%. 98% of 540, DML says 520, 529, 200. 529, 200. This is 529, 200. So what is the total cost? What is the total there? Which is the total here? This is equal to 529. 529, 200. Give me the total cost of inventory under the new policy. Total. Kevin says 533, 700. 533, 700. 533, 700. 533, 700. So what's the difference? The difference is the net benefit. The difference is the net benefit. 9,900. It's 9,900. Is it negative or positive? Is it negative or positive? The cost of inventory, that is the purchase price, ordering cost, and holding cost is 543,600 before the policy. After the policy, after the change in policy, the cost has gone down by 9,900. Therefore, this is a net benefit. If the company was to accept the bulk order discount, then there is a benefit of 9,900. So candidates were to using suitable determine whether the bulk order by the supplier is financially acceptable. So the answer is the bulk purchase discount offered by the supplier is financially acceptable because of the net benefit of accepting the bulk order. Then candidates were to comment on the assumptions made in the computation. Assumptions made in the computation. What are the assumptions? Give me two assumptions. We are just to give two assumptions. Each assumption is a half a mark. And you see, even if you didn't have anything to say, you could comment on the assumptions because the assumptions are constant. When you are calculating cost of inventory, the assumptions that are made. So what is your assumption? Correct. Annual holding cost is constant. That's what DML says. That is correct. What is the other assumption? So it is the holding cost and the ordering cost. So you can see from the question, the holding cost is 0.24 under the old and the new. The ordering cost again is also constant, 150 under the old and the new. So one assumption is that the ordering costs and holding costs are assumed to be constant, which we know is unlikely to be true in reality. Another assumption made here is the annual demand. The annual demand is assumed to be constant. Whereas in practice, we know that there could be seasonal and other changes in demand which may occur. So those are the two assumptions, or even three. Annual cost is assumed to be constant, ordering cost is assumed to be constant, annual demand is assumed to be constant. Questions? Ask questions. We've answered these questions. This is 6 marks. The other question here is also 6 marks. 6 marks. 1, 2, 3. They are marks for workings. 6 marks. Do you have questions? Is there anything you've not understood? If you can understand this one, then you can understand any other. For the other questions I've seen, they are very direct. Questions that have been tested before, quite direct. And I see most of you have been answering questions. I'm very impressed because I know with just a bit of effort in practicing the past paper questions, you should be able to be scoring all these marks. It's possible. Right? Any question? Anyone? Any question? The name advanced does not mean complicated. Advance means continuation. To advance is to continue. It's not complicated. So that's why topics in advance. The topic we are covering, like the capital budgeting, we have advanced capital budgeting. You advance. Okay. When you say so and so is advanced in age, it doesn't mean the person is complicated. No, it means that the person has lived for long. So advanced means you are covering what you are not covered in intermediate level, because it's not possible to cover everything. So that's why you learn bits, then you go to the next stage, you learn more. All right. So this level may look trickier because you are studying, for example, working capital management for the first time. You are studying advanced capital management for the first time. When you get to the advanced level, what you are studying here is the same. We've seen the examiner testing questions from the intermediate level. Like the other setting, there was a question in advanced level on capital rationing, what you've just covered. And there are times when there are questions from advanced level which may also be tested in financial management because the concepts are the same. So by mastering all these concepts, you are making your life easier when you get to advanced level. Okay. So financial management is just financial management. In practice, there is no advanced financial management. It's just financial management. Do you understand? When you get into practice, we do not have advanced financial managers. No, they are just finance managers. And maybe Kasneb should consider changing the word advanced to something else. All right? In fact, during our time, a subject like financial accounting, we used to call it financial accounting 1, financial accounting 2, financial accounting 3. But you see today they are calling it financial accounting, financial reporting, advanced. But it's just accounting. We do not have advanced financial accounting managers. No. Management accounting is just management accounting. When you apply for a job, you are called management accountant, finance manager, accountant. You understand? So what you are learning now is what you will just meet in future. Time value of money, valuation of financial instruments, the formula is the same. So anyone who told you that advanced financial management is difficult is one who didn't attend the lessons that you are attending. All right. you have 30 days. 30 days times, these are days. How many hours are there in a day? Hours, 24. So you have more than 72, is it? Days. Yeah. So you have many hours ahead. Okay. So I think it's just in August when you have the exams and you are doing well. I hope to meet you in our next session. If there is no any other question, we've done questions on working capital management. We've done questions on capital management. We've done questions on an evaluation of instruments. I think we've covered almost each of the areas. I'll be looking at, when we meet next time, a topic that we've not covered. So what you do, please go back to the past papers, attempt questions, revise questions on, for example, working capital management. This question, there was a question on management of data and management of inventory. There are questions again on management of cash. So you see, the examiner nowadays is very clever. He's trying to set questions from all the topics. Like this one has been split. There's a question on working capital, yes, but he's covered all. It's possible to have a question on all those aspects. So go back to the question papers, take advantage of revision books, which I think we have revised up to, is it, I think April 2024. So thank you. Bye bye. Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of 129 million shillings. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So we have 3 years expected results: sales, cost, cash costs, capital allowances, interest charges. We have cash flows to replace assets and finance growth. Additional information number 1. From year 4 onwards, from the 4th year onwards, it is expected that the annual cash flows from Small Limited will increase by 4% each year in perpetuity. Number 2, tax is payable at the rate of 30%. Tax is paid in the same year it falls due. 3, if Duet Limited acquires Small Limited, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as a proportion of total equity plus debt. 4, the cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. 5, the risk-free rate of return is 6% and the return on the market portfolio is 11%. Required. Roman 1. The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on a forward price earnings multiple of 8 times 2 marks. Roman 2, the cost of capital of Duet Limited 4 marks. Roman 3, determine the offer price for Small Limited using discounted free cash flows valuation method. That is the question. All right, 8 marks. Now this one was relatively the easiest question in this sitting. It was relatively the easiest because question is direct. It's very direct. Look at Roman 1. The offer price for small limited, offer price. Assuming Duet chooses to value small limited on a forward price earnings, right? That is the PE multiple of 8 times. Now that means that Duet Limited is considering buying small limited and is issuing or using evaluation method based on the forward price to earnings ratio. Forward price to earning ratio. This is only 2 marks. I'm just taking time to explain, help you understand the question. But the answer is very simple. We just take 8, then multiply by the earnings of this company. It will be 129 million times 8. That is the answer. But I'm taking time to explain so that you understand that the forward price to earning ratio is a method that is used when valuing targets. Okay? The Duet is going to use evaluation method based on the forward price to earnings ratio, and the candidates in valuing the target, the company estimates a company's value by looking at its predicted future earnings. Predicted future earnings. That's why in the first sentence we read that this company is expected to have earnings next year of 129 million. You understand? So this is the answer. This is a Roman 1. The offer price. The offer price will be equal to earnings of the target times the PE ratio. And the earnings of the target, from the first sentence, we get the earnings of the target, 129 million. So 129 million times the ratio. The PE ratio is 8. The multiple is 8 times 8. And that is the answer. 2 marks. We just picked it directly. A forward price earnings multiple of 8 times. So how much is it? 1032. That is 1 billion. 32 million. 1032. 1 billion. 32 million. 1 billion and 32 million. Yes. Agostino, that is correct. Kelvin, that is correct. So that is the answer. 2 marks. Roman 2, the cost of capital. The cost of capital, Roman 2. So when you have such a question, step number 1, put down the formula. Cost of capital, Roman 2. We are to calculate the cost of capital. Now, this is a geared farm. It is a geared farm. And in Roman 3, we read that if Duet acquires more limited, it estimates that the gearing after acquisition will be 35%. So the proportion for debt will be 35%. Okay, which means the proportion for equity will be 1 minus 35%. So this is a geared farm, and therefore we have to calculate the weighted average cost of capital. The cost of capital of a geared farm is the weighted average cost of capital. The weighted average cost of capital, which is equal to the weight of equity, weight times cost of equity, plus weight of debt times KD. That is the formula. So first of all, put down the formula. So the cost of capital of this farm, given that it's a geared farm, will be the weighted average cost of capital. And this is the formula for the weighted average cost of capital. Then we check from the question if we have the weights. And we have just read in note number 3 that the weight for debt is 35%. If the weight for debt is 35% proportion, then for equity will be 65%. So we have the weights. These weights we can pick from the question. Then do we have cost of equity? No, we do not have the cost of equity. What if Agostino asks, what if it was not a geared farm? How would the formula be? How would the formula be? If it was not a geared farm, it would depend, Agostino, on the information provided. And I'm just going to show you right away. Assuming that it was not a geared farm, then the cost of capital will be the cost of equity. Okay, if it was not geared, that would mean that the capital structure, in the capital structure of this company, will only have equity. And therefore, the cost of capital will be the cost of equity. Is that clear? Now, to even illustrate it, Agostino, let us assume there is no debt. Let's assume there is no debt in the capital structure. Therefore, what will be the cost of equity, given the information we have? You can see from this formula, we have the weight. The weight of equity is 0.65. The weight for debt is 0.35. Do we have cost of debt from the question? Yes, in Roman number 4, there is cost of debt of 7.4% before tax. So this cost of debt is 7.4. So you multiply this by 7.4% before tax. And what is the tax? The tax is 30%. So we deduct it. 1 minus t, 0.7. So this will give us a element of debt. Then we have to calculate now the cost of equity, which we are not provided in the question. And that is what Agostino is asking. What if it was not geared? What if it was not a geared farm? How would the formula be? Now, Agostino assumed that this one is not, it is not geared. We only have equity, this equity. What will be the formula for calculating equity? Now, to calculate equity, we need the working. To calculate this cost of equity, we need to have a working, and we are going to use the CAPM formula. Using CAPM, KE should be equal to RF plus RM minus RF times beta, equity beta. So we have to use this CAPM formula to calculate the cost of equity. Now let's check from the information provided. Do you have the risk-free rate? Yes. Note number 5, the risk-free rate is 6% plus. Do you have the return? The return on market portfolio, we have it 11% minus 6. Then there is a note number 4, equity beta is 1.6. So that is the cost of equity. How much is it? What is the rate? Hope says 14%. 14%. Is that true? Can someone confirm? Is it 14%? I need confirmation. Correct. So this is the cost of equity, 14%. With that, we can now calculate the weighted average cost of capital. How much is it? 10.913%. Correct. 10.913% is the cost of capital. Is the cost of capital, 4 marks. Cost of capital, 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Can we proceed? I told you it was one of the easiest of all the questions. Roman 3, determine the offer price for small limited using discounted free cash flow valuation method. And you can see, candidates, this question is directing you discounted free cash flow. That tells you that to determine the offer price, we are going to discount the cash flows. Discounted free cash flow valuation method. You understand? The offer price for small limited using the discounted free cash flow valuation method refers to the present value of small limited's projected future free cash flows. And in essence, the discounted cash flow valuation method aims to determine the intrinsic value of small limited based on its ability to generate cash flows in the future. And this method is widely used in mergers and acquisitions because it provides a comprehensive and theoretically sound approach to valuation of companies. You understand? So we're going to discount the cash flows, and the cash flows are provided in the question. Look at the second sentence. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. Okay? So, Roman 3, the offer price. Okay? Offer price. Now, to calculate the offer price, we have seen we are going to discount these cash flows, and that will enable us determine the offer price. So you can see from the question we have 3 years. So one column will have the years. There are 3 years. 1, 2, 3. Then the next column will have the cash flows in thousands. We'll have the cash flows. These cash flows. Then we'll have the present value interest factor. The present value interest factor. And the rate that we computed in Roman 1, that will be the discounting rate. This is the discounting rate. Okay? Present value interest factor 10%, 10.913 N. Then we'll have the present values. We'll have the present values in thousand. So that is the formula. Okay? Are you following? To determine the offer price using the discounted cash flows valuation method, we'll have the years as given in the question. We'll have the cash flows, the future values of cash flows year 1. We will discount using the present value interest factor 10.913% N. Then we multiply by this factor by the future values. That will give us the present values. Then this total down here will be the answer. That will be our answer. So that is the formula. Okay? Cash flows. Can we proceed? Can we proceed? Can we proceed? Are we on the same page up to that point? Year 1, year 2, year 3. But you recall there was a statement on something to do with year 4 onwards. Yes, not number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. So from year 4 onwards, there is year to perpetuity. From year 4 onwards to perpetuity, they will also have the cash flows. So do we have the cash flows? No, we do not have the cash flows. We have the sales, the cash. So we need to calculate the net cash flows. So we are going to have a working for the net cash flows here. Workings. We are going to calculate the net cash flows. Net cash flows. The net calculation of net cash flows. We are going to have calculation of net cash flows. That is the working. Because here we have sales, year 3, year 3, year 2, year 1. Thousands, in thousands, in thousands. So what we have here, we have sales. These are sales. 300 million, 300 million, 420 million, 480 million. After sales, there is a cash expenses. Cash expenses. We deduct the cash expenses from the sales. 180 million 240 million, 270 million. Then we also have the interest charges. Interest charges 15 million, deduct 15 million, deduct 15 million, deduct. We then deduct the interest charges. Okay, interest charges. Are we following? That clear? We are calculating the net cash flows, which we need to discount here to get the present value. Then the total will be the offer price. So we take sales, deduct cash expenses, deduct interest charges. I skipped the capital allowances. There is the capital allowances, capital allowances, capital allowances, capital allowances, 30, 45, 60. 30, 45, 60. 30, 45, 60. Those are allowances which ought to be deducted. Okay, we are deducting that. Then give me the total here. Year one, 75 million. This is taxable profit. Year two, someone says 120 million, 120 million. Third year, 135,000, 135 million. Then we tax. The tax is 30%. 30% tax. 30% of 75, 30% of 120. How much is it? Year one, tax year one, tax year one. 22,500. 22,500. Year two. Lucy K, 36,000. 36 million. Deduct the tax. Year three, 4,500. 4,500. Right? 4,500. Now give me the difference. Deduct the tax from the taxable profit. That would give us the profit after tax. Year one, 52,500. 52,500 profit after tax. 52,500. Year two, 84,000. 84,000. Third year, 94,500. 94,500. That is the profit after tax. Profit after tax. We then add back the capital allowances. Add back capital allowances. Add back the capital allowances. 30, 45, 60. Add back the capital allowances. 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 Add back. Then there is also the cash flows to replace assets. Cash flows to replace assets ought to be deducted. Cash flows to replace assets. Year 1, 37,500. 45,000. 52, 500. 500. The cash flows to do what? The cash flows to replace assets and finance growth So these are outflows. So you deduct. What you get here is what we are looking for. So what will the net cash flows year 1? Net cash flows year 1. Net cash flows year 1. Net cash flow year 1. Kabasha, net cash flow year 1. Net cash flow year 1. Someone says 45 million. $45 million. Next, 84 million. The third year, what will be the net cash flows third year? 1 or 2? 1 or 2 million. So these are the net cash flows which we are required to discount. Year 1 is 45 million. Year 2, 84 million. Year 3, 103 million. About the discounting factor? The discounting factor, year 1 is just 1 over 1 point. The discounting rate, we have it 1 point. Is it 1.1? 0913. This is the factor raised to 1. Year 2 will be 1 over 1.10913 raised to 2. Year 3, 1 over 1.10913 raised to 3. Factors. Year 3, someone sells 1 or 2. This is 1 or 2, not 1 or 3. So what are the factors? Discounting factors. Discount. The discounting factors. Year 1. Year 3 is 102. But I had written 102,000. Justice says 0.9016. 0.9016 is a discounting rate. Year 2, discounting factor 0.8129. 0.8129. That's Kevin's answer. Year 3, 0.7329. 7329. Then discount. multiply the cash flows, the future cash flows, by the discounting rate to get the present value. Year one, how much is it? Year one, don't round off. These are millions. Don't round off. Don't round off. 40,572. 40,572. Correct? 40,572. Year two, 68,283. 68,283. 68,283. 68,283. 600. 68,283. Is that the position, or is it 0.6? Is it 600 or 0.6? Cannot be 600 because there are 3 zeros here. 68,283.6. Yes, Kabasha, that is true. Then the third year, Agostino says 74,755. 74,755 point something. 0.8. 0.8. 0.8. So these are 3 cash flows. Can we proceed? Yes. Now, we need to calculate the cash flows from year 4 to perpetuity. From year 4 to perpetuity. Look at the additional information number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year into perpetuity, in perpetuity. Now tell me now, what will be the cash flows here? What will be the discounting factor? And what will be the present value? That is your assignment. Give me the cash flows. That is your assignment, class assignment. You do it now. Give me the figure, please. Let me hear from each and every one. What will be the cash flows, future cash flows from year 4 to perpetuity? What do you think is the cash flows from year 4 to perpetuity? That's what we read in note number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4%. From our working, we calculated the net cash flows from year 1 to year 3. Someone, please, help me with the cash flows from year 4 to perpetuity. I needed the cash flows first. This cash flow. This one. And you are right, it is straightforward. Think you are right, Justice. It is straightforward. It is straightforward because this is what we need to write there. 102. It is straightforward. Okay? It is straightforward. But I've seen you've gone ahead to give us the present value annuity factor. You've gone ahead. Multiply, Hope says, multiply the CDS by 104. Multiply the CDS by 104. Now, I needed you to try that way. Multiply the CDS by 104. I think you are adding 100%. You are adding 4% to 100% to get 104%. All right, I needed you to try that way. Now, candidates, look at the question. It says if Duet Limited acquires, the expected results from the cash flows will be as follows. We've seen the cash flows and the expenses. These are the cash flows, the sales and the expenses, and we have computed the net cash flows at the end after year one, after year two. That is the net cash flows. After year three, we have the 102 million. This 102 million, the 102 million is what we are informed in note number 1 that is expected to grow or to increase by 4%. This 102 million, it is after the third year. We are talking about fourth year, from fourth year, because these cash flows are at the end of the years. This is 45 million at the end of year 1, 84 million at the end of year 2, 102 million at the end of year 3. At the end of year 3 is the beginning of year 4. So we read here that from the fourth year, from year 4, from the fourth year onwards, it is expected that the annual cash flows from small limited will increase by 4%. So it is this 102 million from the beginning of year 4 that is going to increase at the rate of 4% into perpetuity. Now, in perpetuity means at the end of year 5, it will also grow at 4%. At the end of year 6, it will grow at 4%. At the end of year 7, it will grow at 4%. At the end of year 8, 4%. At the end of year 9, 4%. At the end of the 10th year, so we can go on and on into perpetuity, okay, continuously. So we need to calculate that amount, which we need to have it here, then we discount it. And to calculate that, we need to use this formula, P naught. The value of these cash flows will be equal to D naught. We are just using D naught, but you can use anything else, okay? It's D naught. Then we grow it at the rate of 4%. That will be into 1 plus the growth rate. Then we divide the rate cost minus the growth rate. This is the formula you covered in financial management. You recall when computing the value of cash flows that are running into perpetuity. This is the formula we use. If you are studying advanced financial management, this formula, you used it and you passed the exam. That's why you are doing this paper. There was a question that was tested in your financial management paper which you passed. And this is the formula that you use to calculate the value of cash flows that are expected to be received into perpetuity. So this D naught is the present amount of 102 million. We grow it. The growth rate is 4%. 1 plus growth rate of 4%. 4% converted into decimal is 0.04. So it will be 1.04. Then we divide it by the rate. Okay, the discounting rate, I think we had it here. That is 0.01, no, not 1, but 0.1, 0.10913 minus the growth rate, 0.04. That will be the amount we need to insert at that point. Is that clear? Yes, Agostino, you had a point. A over R minus G. That is correct. So what is the cash flows? Someone says 1534. 1534 500. 1534 500. 1534 500. 1534 500 point 217. 0.217. So the factor here, discounting factor, this is 4 years, will be 1 over 1.1093 raised to 4. That will be the discounting factor. Raise it to 4. Raise it to 4. So what is the discounting factor? 0.66. Kevin says 0.6689. 0.6689. Present value, multiply that with that, give me the present value 660, 6608, 6608, 08. Present value, present value, what's the present value? What's the present value? What's the present value? What's the present value? What is the present value? 10, 13, 10, 13, 10, 13, 997, 997 point something, 0.743, 0.743. Then the offer price, what is now the offer price? Get the total present values, we'll have the offer price, and that will be the answer. The offer price. This the offer price. The offer price. Total will be the offer price. 1197. 1197. Someone says 1197. 1197 609 point something. 609 point 143. 143. That is the offer price. That is the offer price. These are how many marks? 8 marks. 8 marks. These are calculated values. Calculated values. Calculated values. All this just for 8 marks. Just to earn you 8 marks. 8 marks. Those are workings. You earn marks for correct entries. That is not to say that you should not show your workings. Your workings have to be shown. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Okay, 13 entries. 13 correct entries will earn you the 8 marks. Do you see why I said this paper was, the question was easier? Easy in terms of it will take you a short time to calculate. All these values are derived directly from the question. These ones you pick directly from the question. The only tricky bit that students maybe found a challenge, those who answered this question, was at this point. That was the tricky part. This point. Another trickiest part is this point. If you do not get the cost of capital correct, then all these values will be wrong. a student who didn't get the right weighted average cost of capital, then there is no way this would be correct. Okay, all these marks will be lost, including this. See, we have used it here to calculate that. You've used this to calculate this. Are you following? And you need to be very keen, and that's how the examiner tests papers. If you fail to get the right cost of capital here, then chances are, when answering this question, maybe the only answers that are not affected by this rate is this entry, and that entry. Just 3 entries. Do you understand? Any question? We are through with that question. Do we have any question? I think that last value is wrong. Which one? Which one? Which value is wrong? And you are the one who gave us the value. Which one? The last value? Justice, which value? Perpetuity? For year 4 to perpetuity. 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 He says this value is not correct. How did you arrive at this value? That is a formula. Can you please confirm? Can someone else confirm? You have to grow it. This one is growing at 4%. Any other question? Please take time, go through the questions that are related to this one in the past papers. If you come across any question that you are unable to solve, we can solve it together here on the board, but continue revising. You have enough time. Revise the past papers. Bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still soldiering on with the topic of group account, and in this session I want us to look on an illustration question which requires the preparation of the group account or the consolidated financial statement with a scenario whereby the parent company has invested in a subsidiary and also an associate. So let's go through the illustration and we see what we are told. It reads, on 1st of April 2021, Riziki Limited acquired 75% of the equity shares of Sarama Limited when the retained earnings of Sarama Limited stood at 234 million. The acquisition consideration consisted of cash amounting to 510 million and a share exchange on the basis of 2 ordinary shares of Riziki Limited for every 3 ordinary shares acquired in Sarama. The market value of Riziki Limited shares as at 1st of April 2021 was shilling 16 per share. No accounting entries have been made in respect of the share exchange consideration. The draft statement of financial position of the 2 entities or 2 companies as at 31st of March 2022 are as presented below. So we are given the statement of financial position for Riziki and also for Sarama, where we have the non-current asset including property, plant and equipment, investment, and then we have the current asset which include inventory, trade receivables, bank, and then we have the total asset. We have equity and liabilities. At the equity, we have ordinary share capital retained earnings. Then we have non-current liabilities, which include 6% debentures. And then we have the current liabilities, which include trade payables, current tax payable. And then we have the total equity and liabilities. We have additional information. Number one, you're told the fair value of Sarama Limited net asset approximated their carrying amount with an exception of a specialized piece of equipment which had a fair value of shillings 120 million in excess of its carrying amount. This equipment had 10-year remaining useful life on 1st April 2021. 2. It is a group policy to value non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest in Sarama Limited on 1st of April 2021 was estimated at 144 million. Number 3, during the year which ended 31st of March 2022, Sarama Limited sold goods to Riziki Limited for shilling 64 million, earning a gross profit margin of 25% on the sales. Riziki Limited still held shillings 48 million worth of these goods in the inventory as at 31st of March 2022. Sarama Limited still held the full invoice of shillings 64 million in its trade receivables as at 31st of March 2022. However, Riziki Limited trade payables only showed 34 million as it had made a payment of 30 million on 31st March 2022. 4. On 1st of April 2021, Riziki Limited acquired 30% equity interest in Amua Limited for shilling 65 million in cash. Amua Limited sustained heavy losses over the last few years, and Riziki Limited hoped it would turn it around through significant influence over Amua Limited. In the year which ended 31st March 2022, Amua Limited made a loss of 150 million. Number 5, impairment test performed as at 31st of March 2022 revealed that the investment in Amua Limited had been impaired by shillings 5 million due to sustained trading losses. However, no impairment was required in respect of goodwill arising on acquisition of Sarama. So what are we required? Number 1, determine the value of investment in Amua as at 31st of March 2022, Roman 2. Calculate the value of goodwill arising on acquisition of Sarama Limited, Roman 3. A consolidated statement of financial position for Riziki Limited as at 31st of March 2022. So these are questions for group accounts, and recall what we have been doing in the previous sessions. Once you come across a question for group account, the first thing you need to do is always to come up with a group structure, because the group structure is the one to guide you in terms of how to prepare the consolidated financial statement. So therefore, that is the first thing we need to do here. We need to come up with a group structure. That will be our working one, the group structure. Group structure. So where do we get information about the group structure? In the first paragraph of the question, whereby we are told on 1st of April 2021, the company which is called Riziki Limited acquired 75% of the equity shares of the company called Sarama Limited, and this took place on 1st of April 2021. That is now the date of acquisition, and automatically from this particular information, this now will be the parent company, whereas this will be the subsidiary. But also in the information which we have in note number 4, additional information number 4, we are told on the same date, that is on 1st of April 2021, Riziki Limited also acquired 30% equity interest. This one acquired 30% equity interest in a company which is called Amua Limited, and that took place on 1st of April 2021. 1st of April 2021, meaning that Amua Limited here is an associate. So this will be an associate, because we said an associate is basically an entity over which the parent company has acquired shares lying between 20% to 49%. So therefore, this is what? This is an associate, this is a parent, this is what? The subsidiary. Now, if you go to the requirement, specifically Roman 3, the candidates here were required to prepare consolidated statement of financial position. How do we prepare that? So one, we are going to add similar items of asset and liabilities, those of the parent and those of the subsidiary. But as far as the associate is concerned, we are going to compute something called the investment in associate, and we include that in the consolidated statement of financial position as one of the component of the non-current what? Asset. But before we do that, we need to do some few workings, which then will help us in terms of preparing or basically computing what the examiner is requiring. So if we go back to paragraph 1, whereby we are given information about acquisition of Salama by Riziki, where we are told Riziki acquired 75% equity shares in Salama on 1st of April 2021, when the retained earnings of Salama stood at 234. That is now the retained earnings of Salama on the date of acquisition. That one is used in computation of goodwill. So therefore, when computing the goodwill as required in Loman 2, that will be one of the pre-acquisition reserve. And then we are told the acquisition consideration, the amount of money which the parent company paid in acquiring this particular subsidiary, that is Salama, consisted of cash, which was 510 million, and then a share exchange Recall what we discussed in our previous sessions. Anytime the parent company acquires a subsidiary and pay the purchase consideration through a share exchange, usually the examiner will tell you two things: that the parent company had not determined that purchase consideration, the share exchange consideration, and the parent company had not accounted for that. In fact, if you go to the last sentence of that paragraph 1, you'll see we are told no accounting entries have been made in respect of the share exchange consideration. So therefore, what do we need to do? First of all, we need to compute the share exchange consideration, and also in this case, we must be in a position to know how to account for that. So let's compute the share exchange consideration. And if you can recall what we discussed, which we have already discussed in our previous sessions, to compute this share exchange consideration, number one, we determine the number of shares issued by parent company to pay the purchase consideration. How many shares were issued by Riziki to pay the purchase consideration? Multiply those particular shares with their fair value, or basically the market price, on the date of acquisition. That is a formula which you need to recall here. So, and in this case, we are told that the share exchange was on the basis of two ordinary shares of Riziki. Riziki Limited here was to issue 2 shares for every 3 shares acquired. So the first thing we need to do here is to determine how many shares did our parent company acquire in Salama. For us to be able to do that, to determine the shares acquired in Salama, we need first of all to know how many shares are issued by Salama. Where do we get that information? We go to the statement of financial position of Salama, specifically under equity, and we take into account its ordinary share capital. The ordinary share capital of Salama is equal to 300,000. So for us to be able to determine the shares issued by this company, we divide that with the par value per share. The par value per share is what still we have in the statement of financial position under equity. We are told the ordinary shares issued by these two companies, they have a par value of 10. That applies to the shares of Riziki, to the shares of Salama. So the shares of this company had a par value of 10. So we divide this, and this will give us 30,000. So mean that the shares issued by Salama are 30,000. So how many shares were then acquired by Riziki in Salama? So we know Riziki acquired shares which were equal to 75% of this. 75% of that. So let's work out that. 75% of 30,000, which will give us 22,500 shares. So these are the shares which now the parent company acquired in Salama, That's what we need to have here. The shares acquired were 22,500. So having that, what we just need to do, we cross multiply, then we divide, so that we can be able to determine the shares which were issued by our parent company. So this will be 2 times 22,500. We divide all this with 3. We divide all that with 3. This will give us what? This will give us what? This will give us 15,000 shares. 15,000 shares. So these are the shares issued by the parent company. So from our formula here, we already have the shares issued by the parent company. So what we need to do, we need to multiply those particular shares with a fair value or the market price to determine the purchase consideration. So therefore the purchase consideration here, not the purchase consideration, but let's just refer to this as share exchange consideration. Share exchange consideration. Share exchange consideration. Share exchange consideration would be equal to the shares issued by the parent company, 15,000, times the market price. The market price of Riziki Limited shares is given still in paragraph 1. There is somewhere you're told the market price of Riziki Limited shares on the date of acquisition was 16. So we multiply the 2 so that we can be able to determine the share exchange consideration. So this will give us 240,000. 240,000. So, and take into account this particular amount was not accounted for. Number one, in computing the goodwill on acquisition, the goodwill arising on acquisition of this subsidiary, this will be one of the purchase consideration, because the purchase consideration paid by Riziki, part of it was in cash, which is given in paragraph 1, 510 million, and then we have these 240 million. So the total purchase consideration will be 510 million plus 240 million, and then because the parent company issued shares to pay this purchase consideration, then we're also going to credit this, or basically we're going to increase the ordinary share capital of the parent company with the shares issued by the parent, because the parent company never accounted or didn't account for these shares. That is as per the information given in the last sentence of note 1. So the amount to be credited in the ordinary share capital of the parent will be equal to the shares issued times the par value per share. The par value per share is the amount given in the statement of financial position. The amount given, the value of the share given in the statement of financial position is 10. So that will give us 150. And then the amount which is above 10, because you can see these shares were issued at a price of 16. The amount which is above 10, which is 6, that will be credited, or in other terms, it will be added to the parent company share premium. So therefore, the amount to be added to the share premium, 15,000 times what? Times 6, which will give us 90,000. So that's how we account for that share exchange what? Consideration. That is something we discussed, or we have already discussed in our previous sessions of this topic of group accounts. So I think we are done with that information. Then from there, I think we can go to the additional information number 1, whereby we need to have working 3. In addition, information number 1, we are told the fair value of Salama Limited net asset approximated their carrying value with an exception of specialist piece of equipment, which had a fair value of 120 million in excess of its carrying amount. So basically, this means that this company on the date of acquisition revalued the asset, and anytime the subsidiary company revalue the asset on the date of acquisition, we refer to that as fair value exercise, or in other terms, we can just refer to that as fair value adjustment. And actually, this we said is a normal practice. Whenever the parent company is acquiring a subsidiary, the subsidiary company revalue its asset. But we said the subsidiary company do not account for that particular word, revaluation of assets. As a result of that, we make 2 adjustments here. The first adjustment is adjustment relating to the revaluation gain. And in this case, why do we say there was a gain? Is because we are told that that asset which was revalued, its fair value was more. Its fair value was more, or it was in excess or exceeded the carrying amount with an amount of 120,000. And because the figures in the statement of financial position are in thousand, when taking figure from the additional information, we take it as in thousand of shillings, meaning that we omit the last 3 zeros. So this is a revaluation gain. So how do we account for this gain when preparing the consolidated statement of financial position as required in Roman 3? This one will be added to the group PP. We are going to add this to the group PP, and number 2, we treat it as a pre-acquisition revaluation reserve. When computing the goodwill on acquisition, that will be one of the component of the net assets. Number 2, because the asset which was revalued here is a depreciable asset, actually the asset which was revalued here is equipment. Equipment is a depreciable asset. So what we need to do, we need to compute the depreciation adder charge. We need to compute the depreciation adder charge, and this specifically by Sarama Limited. By Sarama Limited. So how do we compute this depreciation adder charge? You have to recall the formula which we covered in our previous sessions. So we take the revaluation gain, divide that with the remaining useful life of the asset times the proportion of time. Proportion of time, which is now the time difference between date of acquisition and date of consolidation. So the revaluation gain is what we have here, 120,000. And then what are we given the remaining useful life of that asset? Yes, in note number 1, we are told it had a remaining useful life of 10 years. 10 years. And then we multiply that with the proportion of time, the date of acquisition to the date of consolidation. So the date of consolidation is the date we are required to prepare the consolidated statement of financial position as per note number 3, which is 31st of March 2022. And then we have the date of acquisition, which is 1st of April 2021. And actually, this is exactly the start of the current financial year, because even here is ending 31st of March 2022. If you go back 12 months, that should take you to 1st April 2021. So basically here we have exactly 1 year. So meaning that we are computing depreciation adder charge for 1 year, or basically for 12 months out of 12. 12 months out of 12. So this will give us 12,000. 12,000. So this is the depreciation what? This is the depreciation adder charge by the subsidiary company, that is Sarama, which is 12,000. So this depreciation adder charge, number 1, will be deducted from the group PP, and number 2, we're also going to less that from the retained earnings of Sarama, the retained earnings of Sarama. Yes, so that is the consolidation adjustment required as far as note 1 is concerned. Let's move to note number 2. Note number 2, you're told, is a group policy to value non-controlling interest at fair value at the date of acquisition. Anytime you come across such a statement, that is something I've already explained in the previous sessions, is that when computing the goodwill, you compute the goodwill using the full goodwill method. Actually, that information is given to you to help you in terms of knowing which method to use in computing the goodwill. Here we are going to use the full goodwill method, And that's why you can see even in the other sentence we are given the NCI at fair value. We are told the fair value of non-controlling interest in Sarama Limited at the date of acquisition was 144. So we are going to use that information when tackling Roman 1 of that question, whereby Roman 2 actually, whereby we are required to compute the goodwill. So no working as far as for that is concerned. Let's move to working to additional information number 3. We are told during the year which ended 31st of March 2022, which is the current year, Sarama Limited, which is a subsidiary, sold goods to Riziki Limited for 64 million. This we refer to it as intra-group trading. Intra-group trading, intra-group sales. If we were preparing the consolidated income statement, this one is eliminated from the group revenue, the group cost of sales. But in our case, we are not preparing the consolidated income statement. So our interest as far as that intra-group trading is concerned are 2 items: any unrealized profit and any amount of intercompany debt. So we are told it earned a gross profit margin of 25%, and then you're told Riziki Limited, which is now the purchasing or the buying company, still held shillings 48 million worth of these goods at or in its inventory at the end of the year. So anytime you come across that particular information, it basically means that there was an realized profit on inventory, and this unrealized profit on inventory always is by the selling company. The selling company in this case was Sarama Limited, was by Sarama Limited. So equally, you have to recall, how do we compute this unrealized profit? You have to recall the formula. We take the unsold goods times the gross profit margin, times the gross profit margin. So the unsold goods, we are told the goods which were not yet sold had a value of 48 million times the gross profit margin. The gross profit margin, in our case, we are given that as 25%. 25%. This is like a quarter. That should give us 12,000, but we can just confirm that. Yes, so this will give us 12,000, which is the unrealized profit. So which adjustment are required for this? One, we are going to less this from the group inventory. And number two, we also less it from the retained earnings of the selling company. Retained earnings of the selling company, which is Sarama, that is the selling company. Yes, so I think we are done with that. And then still in point number 3, we are told Sarama Limited still had a full invoice value of 64 million in its trade receivables as at 31st of March 2022. However, Riziki Limited trade payables only showed 34 million as it had made a payment of 30 million as 31st March 2022. So what is that? That is information about amount of intercompany debt. Amount of intercompany debt or amount of intercompany owings. So basically we are told this company here that is Sarama Limited still held the full invoice. So basically this company, remember, sold some goods now to the parent company, which had a value of 64 million. So automatically the parent company had not paid for those goods. So meaning at the end of the year, Sarama Limited was expecting to receive 64 million. So that will automatically, or that was included as part of the receivables of this. That's why we are told the receivables of the subsidiary, that is Sarama, included 64 in thousand of shillings, 64,000. So this one will be deducted from the group receivables, and then you're told the payables of this company included 34 million. 34 million. This one will be deducted from the group payables. And in this case, you can see amount of intercompany debt is not the same. Reason being that this company here, at the end of the year, had made some payment which was not yet received and accounted for by this company. And with that one, we refer to it as cash in transit of 30,000. This cash in transit, which will be added to the group cash and bank balanced. Amount of intercompany debt, which is not the same, and therefore you must be in a position to know how do we adjust that in consolidated statement of financial position. I think we are done with that. Point number 3. Let's move to point number 4, is about investment in Amua, which we said is an associate. We are given the purchase consideration, which was paid 65, which was paid in cash, and we are told in the last sentence that Amua Limited reported a loss of 150 million. So that information, we are going to use it in answering part A of that Roman 1 of that question. So no working which is required there. And then 5, impairment test performed as at the end of the year reviewed the investment in Amua. Investment in Amua here had impaired by 5 million due to sustained trading losses. However, no impairment was required in respect of goodwill arising on acquisition of what? Sarama. Any goodwill arising on acquisition of Sarama had not what? Impaired. So I think now with those particular workings, we can go straight to what is required. We start with Roman 1 of that particular question. Roman 1, we are required to compute investment in Amua investment in Amua Limited. In Amua Limited. So remember, Amua Limited is an associate, and therefore what the examiner here was requiring the candidate to compute is the investment in an associate. So this is something we discussed in our previous session, how to compute the investment in associate. So what we need to do here is to have a single column, and all our figures are in thousands of shillings. So what do we start with here? So we always start with the cost of investment. The cost of investment is the purchase consideration paid by the parent company in acquiring shares of the associate, that is Amua. And that information, we have it in note number 4, whereby we are told on 1st of April 2021, Riziki Limited acquired 30% equity interest in Amua for shilling 65 million. So in thousands of shillings, that will be 65,000. So to this, what do we then add? We then add the group share of the post-acquisition retained earnings of Amua. So in this case, as per the information which are given in note number 4, the associate, that is Amua, reported a loss. So therefore, in this case, we are not going to add the group share of the post-acquisition retained earnings, but we are going to less. We are going to do what? We are going to less the group share of post acquisition loss of the associate because during the current financial year, remember this associate was acquired exactly at the start. So therefore, the loss it reported during the current year is a post-acquisition, is a loss reported by Amua after it was acquired by the parent. So that loss in note number 4, the last sentence, 150,000 or 150 million, this is a post-acquisition loss. What we do is that we compute the parent company share of this. The parent company share of that will be 30%, and because it's a loss, we less it there. And also to this, what do? We less any impairment loss. So if this investment in associate has impaired or its value has reduced, we less that there. Are we given any information as far as that is concerned? Yes, note number 5. Impairment tests performed at the end of the year revealed that the investment in Amua had been impaired with 5 million. 5 million. 5 million in thousands of shillings, we take that to be 5,000. So let's compute this, and then we get the final answer. So we get 30% of 150,000, which will give us 45,000. Remember, these are loss, so we less it from our figure up there. So we have 65 minus 45 minus 5. This is a total of 50. So this will give us 15,000. 15,000. So 15,000 is what? Is the investment in what? Investment in Amua. Investment in Amua. And actually that's what the examiner was requiring there. And so these automatically were the items to be marked there. That one, and that one. So any candidate was able to do that. Got now the allocated marks there. Okay, so let's now move to Roman 2 of the question. In Roman 2, we are required to compute the goodwill arising on acquisition, goodwill on acquisition of Sarama Limited. Goodwill on acquisition of Sarama Limited. And equally, you have to remember in computing this particular goodwill on acquisition of Sarama, as per the information given in note number 2, we are using the full goodwill method. We are computing this goodwill using full goodwill method. Full goodwill method. So what we need to do here is to have 2 columns. So how do we compute this goodwill? First of all, we take the purchase consideration. The purchase consideration is the amount of money which was paid by the parent company in acquiring 75% stake or 75% interest in Sarama. So as per the information which we have in paragraph 1, we know that part of this purchase consideration was in cash. So we have cash consideration, which you are told in paragraph 1 is 510 million, but in thousand of shillings it will be 510,000. So we also have this share exchange consideration also as per the information given in paragraph 1. But remember, he said this share exchange consideration was not given. That's why we computed that. So we have share exchange consideration, which is 240,000. So this is the purchase consideration paid by the parent. And because we're using the full goodwill method, there is something else we need to add here, the NCI at fair value. NCI at fair value. Do we have that information? Yes, we have it in note number note number 2. NCI at fair value is 144 million. So we add all this, that is, we add all this, so that then we less the net assets which were acquired. So we have 510 plus 240 plus 144, which will give us 894,000. So and then to this, what do? We less fair value of net assets acquired. Fair value of net asset acquired. So this is something which the examiner will not give you. Is upon you to compute this, the fair value of the net asset which were acquired. And actually to compute these from what we have already discussed in our previous sessions. We need to compute the fair value of Sarama Limited net asset on the date of acquisition. How do we compute that? We compute that by taking the ordinary share capital of Sarama plus all pre-acquisition reserves plus all the reserves Sarama Limited was having at the date of acquisition. So the first thing we do is to go to the statement of financial position of Sarama, specifically in the equity section, and we take into account its ordinary share capital. The ordinary share capital of Sarama is 300. And actually we said also, if that company is or if you also given the share premium there, you also include it there, but we don't have. And then what we have still at the equity is the retained earnings. But also recall from what we have been discussing in the previous sessions, the retained earnings which we include here is the retained earnings on the date of acquisition. And we have that in paragraph 1 of this question. The retained earnings of Sarama at the date of acquisition was 234 million, but in thousand of shillings will be 234. Yes. Then from there is something else you also need to check. You need to check whether Sarama Limited on the date of acquisition revalued the assets. If that company revalued the assets, there was any revaluation reserve, you include it here. And actually we have that. Recall this working 3. So on the date of acquisition, Sarama Limited revalued an item of plant. There was a revaluation gain of 120. So that is one of the pre-acquisition revaluation reserve. Yes. So we don't have any other. So what we just need to do is we get the total here. We get the total. So we have 300 plus 234 plus 120, which will give us 654. 654. And because you're using the full goodwill method, we take 100% of this because we are interested with the net asset acquired by both the parent and NCI. 100% of that, which will be 654. So we less that from the figure we have up there, and we get the goodwill. So minus 894, which will give us 240,000. So 240,000, this is the goodwill on acquisition, and actually this is the full goodwill. Full goodwill means that that is a goodwill attributable to the parent and the goodwill attributable to who? To the NCI. So that is it. That what was required, and equally there the candidates were allocated 3 marks. So the items which are marked in such a case are these items. These are the items. If you got any of those, or basically if you got those particular items, then you got the allocated 3 marks. So we are done with that. Then we proceed to the last part of that question, whereby the candidates were required to present or to prepare a consolidated statement of financial position of this group. So we have Riziki group consolidated statement of financial position as at 31st of March 2022. 31st of March 2022. So how do we prepare this? So in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of the parent and those of the subsidiary. But as far as the associate is concerned, we don't include its asset and liabilities here. In fact, that's why in this particular question, there is nowhere we are given asset and liabilities of AMUA. So what do we include here as far as the AMUA Limited is concerned is something called the investment in AMUA, investment in associate, and that is in accordance with the International Accounting Standard number 28, which requires that when the parent company is preparing the consolidated statement of financial position, it should not include the asset and liabilities of the associate there, but it should only include the investment in associate, which we computed here. So therefore, that's how we are going to present this. So let's start with the non-current assets. So for the non-current asset, we start with the PP. So PP, we take those of the parent, 1593, 1595, 1595, 300, plus those of the subsidiary, 636, 400. And then from there, we need to check whether we have any consolidation adjustment affecting group PP. Do we have any? Yes. So we have this one. So we have the revaluation gain of 120, which we said we add to the group PP. So we add 120. And then we also have this depreciation other charge of 12. We less it here. We less it here. So we will get the final figure. So that is for PP. Then below that, what do we have? We have investment. Now this investment, the examiner will not tell you, but this is the amount now the parent company had invested in Sarama, had invested in AMUA, and that should not be included here. So the purchase consideration which was paid in acquiring shares of Sarama, that one is used in the computation of goodwill. So that's why we are saying that the amount invested in Sarama, you don't include it here. What we include here is the goodwill. Equally, the amount invested in AMUA, we don't include it here, but rather we include now the investment in AMUA because this amount has been used in computing what? Investment in AMUA. So the investment which you are given there is 575, and this one includes the cash consideration paid by the parent company in acquiring shares of Sarama, which is 510. So we need to less it here. And also this included this amount of 65, which was paid in acquiring shares of AMUA. So if you less this, you take this minus this, that will automatically give us 0. So that is the amount invested in AMUA and also Sarama. We don't include it here. So what instead we include here is the goodwill arising on acquisition of Sarama Limited, which we have computed here, 240,000. We also include now the investment in AMUA, Limited, which we have computed here, an amount of what? 15,000. 15,000. Yes. We will come back and compute this, but let's first of all proceed and code current assets. For current assets, we have inventory. So for inventory, we are adding the inventory of the parent, 165, plus that of the subsidiary, 160. So do we have any consolidation adjustment affecting inventory? We have to check whether we have unreleased profit on inventory, and we have it here, an amount of 12,000, which we said we less that from the group inventory. So we less 12,000. 12,000. Do we have anything else? No. We'll get the final figure. Then from there, below that, we have trade receivables. So for the trade receivables, we take those of the parent, 247,100, plus those of the subsidiary, 107,800. And then to this, we should less any amount of intercompany debt. Any amount of intercompany debt. Do we have amount of intercompany debt? Yes, this one 64, which we said we less from the group receivable, 64,000. And then below that, what do we have? We have the bank balance. Bank balance, we take that of the parent company, 21,000 plus 13,800. And then also to this, there is an adjustment for cash in transit. Cash in transit. Cash in transit, we add it here, 30,000. Yes, and then from there, we will get now the total asset here. We will get the total assets. Total assets. So let's compute those figures here. We start with the PP. For PP, we have 1595, 300 plus 636, 400 plus 120,000 minus 12,000 minus 12,000, so which will give us 23, 39, 39,700, 23, 39,700. So we already have that, this. So then let's compute the group inventory. So 165,000 plus 160,000, that is 165,000 plus 160,000 minus 12,000. So which will give us 13,000. What about receivables? We have 247, 100 plus 107, 800 minus the amount of intercompany debt, 64,000, which will give us 290, 900. What about the bank? We have 21,000 plus 13,800 plus the cash in transit of 30. So which will give us 64,800. Then we add everything here. We have 290, 900 plus 313 plus 15 plus 240 plus 2339, 700, which will give us a total asset of 32,63,400. Yes, so that is it. We proceed. Then we record equity. We record equity. So for equity, we start with the ordinary share capital. Ordinary share capital. You have to recall that for the ordinary share capital, we only include that of the parent company. That of the parent company only. So for the parent company is 850. But you also have to recall here that our parent company, in paying the purchase consideration after acquiring Salama, part of that purchase consideration was paid by the parent company issuing its own shares, which the parent company didn't account for. So therefore, we said to the ordinary share capital of the parent, we are going to do what? We are going to add 150 to the share premium of the parent. We add what? 90. So to this, we are going to add 150, which will give us 1 million. And then we also have this share premium. We also have that share premium arising from those shares which were issued, the share premium is 90,000. Is 90,000. So then from there is something we need to compute here called the group retained earnings. This one is not given. We have to compute it. We have to compute that, including something else called the non-controlling interest. Non-controlling interest not also given. We are going to compute those two items once we are done by with recording the other items. So then from there, let's proceed and record liabilities. Where do we need to record? Where do we record our liabilities? We record our liabilities here. I think we can do away with this. Yes, so let's do away with whatever you have here. Yes, next we record the non-current liabilities. Non-current liabilities. We have 8% debentures. So for the 8% debentures, we add that of the parent for 60, that of the subsidiary, which is 40. No adjustment for this, which will give us 500,000. 500,000, and then we record current liabilities. We have trade payables. Trade payables. We add that of the parent, 442,000 plus 167,200. And we have an adjustment for this relating to the amount of intercompany debt of 34, which we need to less from this, that we less 34,000. Okay, then next or below that we have the current tax payable. No adjustment for this. We have 108,000 plus 52,800. 108,000 plus 52,800. No adjustment for that. So what we need to do, we need to get the final figures here. So we start with the tax payable here, whereby you're going to take 108,000 plus 52,800, which will give us 160,800. What about trade payables? We have 442,000 plus 167,200. 167,200 minus the amount of intercompany debt 34, which will give us 575,200. Yes, so then we will get the total equity and liabilities. Total equity and liabilities. But before you do that, there are two items we need to compute here. Let's start with the group retained earnings. We start by computing the group retained earnings. Group retained earnings. And in terms of how we compute this particular group retained earnings, we take 100% of the parent company retained earnings. 100% of the parent company retained earnings. 75% of the subsidiary post-acquisition retained earnings, and then for Amua, which reported a loss, we take now the group share of the post-acquisition loss. So meaning that here we're going to have the three companies, that is Riziki, Salama, and Amua. So for these two companies, parent and the subsidiary, we are going to take the retained earnings as given in the statement of financial position. In the statement of financial position, we have the retained earnings for Riziki and Sarama, which is 743,400. For Sarama is 358,000. So this one is not given. And actually I've said for Sarama, not for Sarama, rather for Amua, we are going to include or to take into account its profit for the current year. because not the profit actually, because during the current year this company reported a loss. We are going to take its loss for the current financial year, and actually we compute the group share of the same. Yes, so therefore that's basically what we are going to factor in here. So as far as this the retained earnings of the subsidiary company is concerned, first of all, you need to eliminate the pre-acquisition retained earnings that only apply to the subsidiary, and which is given in the additional information number, the first paragraph. It retained earnings on the date of acquisition was 234,000, such that we shall be left with only the post acquisition. Post acquisition, so 358 minus 234, 358 minus 234, which will give us 124,000. And then what we need to do is also for AMUA here, we can just include the loss for the year. Loss for the year. For the year. This applied to AMUA. It had a loss of how much? That is in the information number 4, which is 150. 150. Yes, 150. Remember, these are loss. We take it as a negative. Then we need to check the various adjustments affecting the retained earnings. Affecting the retained earnings. Think working 1, working 2 will not affect the retained earnings. Working 3 here, these will not affect the retained earnings, but we have depreciation under charge by Sarama of 12, this one, which we said should be deducted from the retained earnings of Sarama Limited. So this 12,000, so which is the depreciation under charge specifically by Sarama to be deducted from its retained earnings, 12,000. Okay, so then we have this unrealized profit still by Sarama to be deducted from its retained earnings, and realized profit by Sarama of how much? Still 12. Still 12. So this amount of intercompany debt will not affect that. Yes, I don't think we have anything else here. Do we have anything else? We have this depreciation under charge and realized profit. Let me see from the additional information. I think we have dealt with additional information number 1. Number 2 is about unrealized profit. Number 4. Yes, and then we also have what? We also have the impairment loss. We have the impairment loss. Yes. So this investment in AMUA had impaired, and basically that is impairment loss is recognized as an expense by the parent company here. Impairment loss. Yes. So we get the net amount here, so that now we get the group share of this. We get the group share of this. So let's get the net amount. This should be 100,000. This will be what? Will be 738. 738. Then we get the group share of this. The group share of this will be 100%, 75%, and this one will be 30%. 30% of that. So let's work out that, which will give us now the group retained earnings. So this will be negative 45,000. This will give us 75,000. This will give us 738,400. Then we need to add all that. 738,400 plus 75,000 minus 45,000, which will give us 768,400. 768,400. 768,400. So I think first of all we can get the total equity here before computing the non-controlling interest, which will give us 1858 400. And then next what we need to do is to compute the non-controlling interest. Non-controlling interest. Let's have that working here. Non-controlling interest. So the non-controlling interest, you have to recall that this is the minority shareholders' share of the net asset in the subsidiary. So the non-controlling interest. So how do we compute that? To compute this, we take what? We take the NCI at fair value. NCI at fair value, which we have in the additional information number 1. NCI at fair value, we have it in note number 1, which is a figure of 144,000. And then to this, what do we add? We add what if as a to this we add, that is NCI at fair value. To this we add the NCI share, of post acquisition adjusted retained earnings of the subsidiary, that is of Sarama Limited. So we already have this, the post acquisition retained earnings of Sarama, which is what we have here, 100,000. So we basically compute the NCI share of that. So NCI share of this will be equal to 25% of this. 25% of that, which will give us 25,000. Yes, and I think we are done. So what we just need to do is to add this, which will give us 169,000. So 169,000 here. Yes. So I think we are done. So what we just need to do is we add all those particular figures. So let's start by considering what we have here. The total equity, which is 1858,400 plus NCI 169,000. 169,000 plus the debentures, that is a figure of 500,000 plus payables 575, 200 plus 160, 800. Yes, 160, 800. Yes, and actually that is giving us the same figure there, 32, 63, 400. I hope that is the same figure we have there. Yes, the same figure we have there. So basically that is it, that what was required. So your statement of financial position was supposed to balance at that point, and basically by doing that, the candidates were supposed to get 8 marks. So meaning that the items now which are marked here include PPE, goodwill, investment in Amua, inventory, receivable, bank, share capital, retained earnings, NCI, share premium, debentures, that, yes. So those are basically the items which are supposed to be marked, and by doing that, the candidates were supposed to get 8 marks. So basically that is it, that what was required as far as that illustration is concerned, and that brings us to the end of that session. It is bye for now.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, today we are discussing about business and data analytics, which is an exit paper under the CPA qualification. We are doing section 2, question 21. And as you can see on your screen, the question reads as follows. You are provided with the following extracts of the statement of profit and loss for Sepetuka Limited. So you can see you've been given the statement of profit and loss from the years 2019 through to 2022. The sales are provided, cost of sales, the gross profit is also given, operating expenses, operating profit, depreciation, profit before interest and tax, finance costs, profit before tax, income tax expense, and profit after tax. You are required, A, to calculate and interpret the following ratios. Number 1, the annual revenue growth rates for years 2020, 2021, and 2022. So what I'll do, I will just copy this extract over here onto the right of your screen, copy, and what you've learned in terms of the shortcuts, Control V, you can be able to see it's actually come easily there. What I need to do is that I need to differentiate between the question and the answer in terms of color. So I come to home and I just press blue there, it changes the color immediately. So in trying to answer part 1, which I can be able just to do right down over here. So part 1, that, then I put it in brackets over here. Because you're beginning from 2020 through to 2022, I will just indicate over here 2020, 2021, and 2022. So then you don't even need to write anything. So if you've got, like, say 10 years, you just drag this, it tends to pick. But if it doesn't pick, you click this autofill options icon there. You're supposed to fill the series. You just fill the series and it comes like that. So the reason for that is because you could be able to have at least a 10-year period that you want to generate the years. So you don't have to just keep on writing or typing on your keyboard there. You just drag and you come to autofill options over here, then you fill in the series there. So here, the formula, I'll just write it just beside over here of how to compute part 1. The annual revenue growth rates, you pick the value at the end minus the value at the beginning, then you divide by the value at the beginning. So you come to insert, you can see right over here, insert, and I want to insert an equation so that we can be able to move forward ahead. What do I want to insert? A fraction that looks like that. So this is what I get, and I can just drag this towards the right of the screen if it allow me. You can see it right here. And I put what I've just said there. So I'm talking about the wealth at the end of the period. Then I subtract the wealth at the beginning of the period, like that. And then I divide that against the wealth at the beginning. So wealth at the beginning. In form of a shortcut, we can be able to just write down over here or what? Or which other formula, which is usually shorter. So I center that. We come over here, ladies and gentlemen. So I just try and differentiate that by inserting like that. Or I can say wealth at the end divided by wealth at the beginning minus 1. It will still give you the same result. So I insert again a fraction or an equation. Then I come here fraction because I'm inserting like that. You could either select either of the options which will provide you, so long as you have a fraction. So you can just pick here that the wealth at the end, you divide that against the wealth at the beginning, and then you press the right arrow minus 1, and you can be able to see it's over there. So I didn't press the minus, so the minus 1 there, like that. So just to enlarge it, over here you can just see it clearly. Over here, once I try and enlarge it, like that, it should be able to give you the same result there. So once you increase the font to say, for example, maybe say 12 or 13 like that, you can be able to now clearly see what I'm talking about over here. But I remove this minus sign to ensure that it's correct there. So we, for simplicity's sake, we'll apply this second formula over here onto the 2020 period. So you pick the value at the end, and we're talking about what? We're talking about revenue. So sales is the same as revenue. So we pick plus. In Excel, you must put plus the value at the end, or the wealth at the end. Then we divide that against the wealth at the beginning like that, and then we minus 1 like that. So you will continue. Now, how long will you continue? You've got, say, 10 years to continue. Will you be able to do that continuously for 10-year period? No. We're saying we apply the same concept we've already just learned over here. So I just drag the formula like that, and it will actually pick for the annual revenue growth rates. But revenue growth rates should be expressed in percentage form. So where do we go? We come right over here under number. But if you prefer using the keyboard, we can be able to press Alt, and then we can be able to see, because we have to talk about home, so H. And what do we want? You can see here, right here clearly, we press P, it should give us a percentage. P refers to a percentage like that. So we just click P, and you can be able to automatically see, ladies and gentlemen, it actually gives you a percentage there. So before we move to part 2, I can say part 1 was asking about what? Annual revenue growth rate. So I can just write here annual revenue growth rates. Like that. So it may be overlapping, no problem. We just come over here and double click. You can see that plus sign over there, that plus that's there. Just double click, and it actually opens it up like that. Part 2 over here is asking us the 3 years cumulative average growth rate, CAGR. The industry convention usually refer it to CAGR. So when we compute the CAGR for 2022, it means that we need to pick this value here, allow me to highlight it in a color there, and this value right over here. So we'll apply the same concept that we have discussed right over here. You can see it still on your screen over here. However, we'll apply it based on the 3-year CAGR rate. How do we do that? So I can say 3-year cumulative average growth rate, year CAGR, allow me to use CAGR, like that. And it will only appear, ladies and gentlemen, right here, because we're not looking at the average, the CAGR rate for 2020, 2021, 2022. We're looking for that period up to there. So what we can be able to do, we just pick plus the value at the end of that 3-year period. Then we divide that. We are applying this similar formula, a similar formula to that over here. We divide by the beginning value. We need to insert it in brackets so that we can be able to ensure that the formula is complete. Then we raise it to how many years? Power. So power is, you press Shift and 6. You can see 6 on your keyboard. It shows above 6, there's a kind of like a power there. That represents power. So power, we open the brackets, power 1/3 or 1/3, like that. And then we minus 1, or we subtract 1. So we subtract 1 over there, and we see what the CAGR is for the 3-year period. Press enter. It gives you 20.96, but we want it in form of a percentage. Remember what we said? Alt, we press H. You can see what H gives us, home, H, and then now we want percentage, P. You can see we press P, represents the percentage, so we press P. Automatically gives us 21% like that. If you want it maybe in 2 decimal places, we still come over here. Now I'm not going to use the keyboard or the shortcuts. We're going to come over here and increase it using increased decimal like that. So we just increase it like that and like that. So 20.96, 21% is okay. We move on to part 3 of the question over here. So that's you can just drag it down over there. Then you just add one of the you can just add I onto it, so it can be able to represent part 3. Part 3 is asking us to compute the effective tax rate for the period 2019 to 2022. How do we get the effective tax rate? Now in this case over here, what I can be able to do, because they're asking us for 2019, I'll be able to just perhaps maybe just I'll include it over here because it's asking us from this year here. So allow me to use the effective tax rate, or I can be able to just insert here, insert a column like that, and then what I can do, I drag this back towards this other side over here, and there's no problem with dragging on that. So just drag it like that, it will just pick like that, or you can copy, whichever you prefer, right there. So once we have that, so we double click on that, it will open up like that. So we want the effective tax rate. That. The effective tax rate, we will pick income tax expense, we divide it by the profit before tax. But now we can see that the income tax expense is a negative value, so we need to adjust for that. So how do we do it? So you just pick plus in Excel, we pick the income tax expense, but before we put the plus, because we'll get, if you see what we'll do, we'll pick the income tax expense and then we divide against the profit before tax like that. It will give us a negative answer, negative 0.3. There is no tax rate that is negative. So what do? I just clear that. We pick plus and then we put a minus sign there, plus minus, you can see. So I've picked that value and I divide that against the 5200 like that. Gives us that, but we want it in percentage form. So we highlight, we first of all drag the formula for it to pick until you see that plus sign, ladies and gentlemen, not this plus sign, you drag it to the bottom right hand corner, bottom right hand, until you find that plus sign, you drag it like that, and you should be able to get the tax rate like that. Remember what we did? Alt H, then we press P for percentage. P gives us 30% like that. So once we have dragged the formula, you can see the effective tax rate is 30% all through from 2019 to 2022. This answers the third part of the question, which was asking us to compute the effective tax rate for that period 2019 to 2022. Before we conclude, let's just recap what we've just discussed. In part 1, they wanted us to compute the annual revenue growth rates for years 2020, 2021, 2022. And you can see we had already computed them right over here. How we compute the annual revenue growth rates, we have the formula on the right of our screen here. Value at the end minus value at the beginning divided by value at the beginning. Or short form, wealth at the end divided by wealth at the beginning minus 1. For the cumulative annual growth rate, which is also called CAGR, industry convention, we compute the 3-year CAGR as follows. We first of all get the wealth at the end. We divide that against the value at the beginning of the 3-year period. Why we're saying it's 3 years, it's because from here to here is 1 period, from here to here is 1 period, and from here to here is 1 period. So that represents 3 years. So we get the value at the end, we divide that with the value at the beginning, we raise that to power 1 over 3. Why 1 over 3? Because we're talking about the 3-year period, or the 3-year growth period, 2019 to 2020, 1 period, and another period there. So it's raised to power 1 over 3. And then you subtract 1 to be able to give us the compound annual growth rate. And you can be able to see the formula once I've clicked over here on this part, the formula bar. If I double click it, it will highlight those values that I've picked. Value at the end divided by value at the beginning. Then you raise it to power 1 over 3 for the 3-year period minus 1 there. For the tax rate from 2019 through to 2022, we just picked, because we have seen the tax rate is negative over here, we cannot be able to have a negative tax rate. We picked just the income tax expense here. We divided that against the profit before tax, and we got that value there. So to double click, you can see I've picked that value, L19, which is this one here, divided by L18, like that. And then, of course, to convert it into percentage, you just click this button over here like that, and you drag the formula as you move towards the right. This brings us to the end of part A, question 21, which came in December 2022 Business and Data Analytics paper. Thank you for being with us. God bless you. Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to solve a business and data analytics question that came in December 2022. The specific question is question 23, and it reads as follows. You are evaluating 4-year project with an initial investment of 10 million on 1st January 2023 and the following cash flow characteristics. So you can see the dates have been provided, the cash flows have also been provided. The discount rate is given as 8%. You are required to, number 1, calculate the NPV and ex-NPV for the project and hence determine whether the project is viable. Number 2, highlight the cause of the difference between NPV and ex-NPV. Explain which one you would use in your analysis and why. B is asking us to calculate the IRR and ex-IRR of the project and hence determine whether the project is viable. Part 2 is asking us to highlight the cause of the difference between IRR and ex-IRR and explain which one you'd use in your analysis and why. So ladies and gentlemen, I will zoom out a bit like that so that I can be able to solve it on the right of your screen, right here where you see solution. So what I'll do, I'll just copy what is right on this table, and you can be able to see it right there on your screen there. So the dates have been provided and the specific cash flows have also been provided there. So we solve part A. So I'm just going to correspondingly put it beside each question so that now we can be able to move systematically and together. So part 1, so A part 1, this is A, that, and then part 1, just beside it over there, 1, that. It's asking us to calculate the NPV. So what I'll be able to do, I can be able to just do the NPV over here, and you're being asked to compute also the ex-NPV. So the NPV, NPV, and ex-NPV will appear over here, ex-NPV, ex-NPV. So with your permission, I'll put it just above so that we can ensure that now the answer is going to appear right over there, and the answer is also going to appear for ex-NPV at the appropriate place or location there. So I'll just do that. I'll just type over here ex-NPV, that, and then I just delete this, that. So NPV just tries, it only considers cash flows, or these cash flows is what is actually considered under the computation of NPV. And we have been provided with the discount rate or the appropriate discount rate for the NPV, and you can see it right over here, it's 8%. So what we do, we click right there and first of all get the present value over there. So we come to the formula bar, you can see right over here where there's FX, we click there and we search for NPV. You can see this dialog box over here, or this box section over here, the search function over here. You click or you type NPV like so, and you go like that. It will search within the formula list there, and you can see over here it's NPV. So you click NPV, double click it. So it gives you this dialog box with function arguments. So the rate is provided, we just slot in the rate as it is, 8%. You can see it automatically converts it into a decimal there. So now we insert the values over here. And because we're using this right part of our screen, you remember NPV, we just first of all insert value 1. We move on to value 2. And it continuously proceeds on. As you can see, value 3, value 4, and so on and so forth. You may have 20 values or 100 values. It will be able to provide for that. That's the good thing about Excel. So value 2, we put in the next value there. Value 3 is which one? Is that one there, E7. Value 4, you put that value like that. So we've put in the rate and the corresponding values over here. So we just click OK, because we've already exhausted that. Remember, we have not factored in the beginning cash flow over here. So what we're going to do, we will be able to now, so we can see if you put those, if you see those hash signs like that, I just double click on there. It even gives you the value in terms of Kenya shillings there. So it's 10 million. But this is not the NPV. This is the present value. So you can just put over here present value. Present value. Pardon me, the spelling, value. Like that. Then I delete those ones there. So that is the present value. But for us to get the NPV, I can click the NPV over here, or I put the NPV just down over here like this. So the NPV will be, you get the total present values over here. So you pick plus the total present value. Then you do what? You subtract the initial cash outlay, which is negative over here. But now because it is negative, remember guys, what we do, we add. Because that, so that you can factor in the negative sign. So we add that value there, and you can see the NPV just gives you like that. So if you want in a similar format over here like that, you just come to Format Painter and put it now in terms of Kenya shillings over there like that, because we're dealing with Kenya shillings. So that represents the NPV right there. So we can then proceed on, still in part A, we can compute the XNPV. So the XNPV, please note that maybe I had not arranged this very well, but this should give us the present value like that. So what I can do, I can just drag this, I just cut and I paste it just down over here so that it can be consistent. So we're still doing part 1. So this side computes the present value over here like that, and the XNPV will be computed right on this side over here. So this one, I just drag it down. So just cut it right there, paste it right over there for consistency. You can see it shows the NPV there. For XNPV, because it's going to give us a direct value, we are going to consider all of the dates, the timing of the cash flows. That's the difference between NPV and XNPV. NPV, you'll see, we only factored in just the cash flows. We did the present values. There's nothing to do with the dates. Now, let's see how different XNPV look like over here. So, come over here, we click there, we go to the formula bar, click FX, and now we search for XNPV. XNPV. That, press go, and it gives us their XNPV. So you say, okay, fine. What is the rate? The rate is 8%. You can see it over here. The rate, discount rate is still 8%. So you put 8%, converts it into decimal. We slot in the values as they are, including negative values there. So we slot in, we just highlight that. That's it. And then we slot in the dates. It gives us a provision for the dates. So we highlight that, corresponding dates for the cash flows. And we say, okay, that is the XNPV. So we put it in terms of consistency, for consistency's sake, we put it in Kenya shillings. So we double click over here. When you see that arrow pointing in both directions like that, double click It gives us Kenya shillings like that. So please note, I have not used that cell to get the present values. I just got the XNPV directly there. And that answers our part 1. We are not done with part 1. We only halfway done. It's asking us on the left of the screen, calculate the NPV and XNPV of the project and hence determine whether the project is viable. In both cases, we can see there are positive cash flows here. So we can say right over here viability or decision over here. Over here we put it in green. We can even put plus or if statement there. We can put an if statement and say if, you can see if comes over here, if that value, sorry, doesn't give us like that, so it's put plus if, like that, click over here, double click it, if that value is positive, and you can click on the formula bar over here to ensure that you're checking, you're doing the right thing. If D15 is a positive, then we say accept. If it is negative, then we can put a comma and say reject. Like that. So, comes there. We accept. We can drag that formula and put it like that. So both cases we accept because it's positive. It gives us positive cash flows. We can even include conditional formatting by saying we can add color scales. We just give a rule, a new rule over here, and say that we want only cells that contain cell value is not between, equal to or greater than. That's what we want, greater than 0. So we select that. If it's greater than 0, accept. I'll put it in caps. Accept, like that. Greater than 0, we put 0 here, like that. Then we say over here you can just format and put it, maybe you can put, not font, we want to fill in a color to put it green, like that. Okay, if it's greater than 0, okay, and we say okay. So you can see they come green. But if it is less than 0, you can change you can put another rule over there. Conditional formatting, color scales, click on color scales, new rule. Then you come over here, cells that contain. If it is, you come over here, less than 0, then you come to format, you put a red sign there. Okay and okay. Meaning that if, for example, over here we got negative, let's just put maybe a negative value like that, let's say negative 50. So negative 50, like that. It changes the color scale to red, you can see. But we're not supposed to accept. Here is where we change the decision. You can put even conditional formatting over here. New rule, cells that, or rather we can put cells that contain, rather, if we can just come over here, cells that contain cell value, so you can put the cell value, accept, yeah, you can put it equal to accept, like that. You can put it even in small letters over here, accept, like that. You can put it in red, you can put it in green, pardon me. So you put it in in green over here. So we format, we put it in maybe a lighter green like that. So you can put it like that. Or it was this one, it was this one over here like that. So we say okay like that. But if it is reject or reject over here, so let me just explain it again over here. You're saying this value is picking from over here. If it is positive, we accept. If it is negative, we reject. So like now, if it is in this case, you can see it's accept. So if plus if, so that value is greater than 0, you can put it greater than 0. Shift greater than 0. You can come to the formula bar over here if you're not sure what you're doing. It's greater than 0. If it is true, accept. You can put it in caps, accept, like that. If it is false, reject, like that. And you just click OK, like that it will come up, of course, like that, accept. So you can drag that. Now this one looks better as compared to the other previous one that was there like that. So I'm just waiting for the plus sign like that, accept. Now if I put negative 50, I didn't put another condition of formatting over here. If I put negative 50 like that, the previous rule holds. But if I put negative 20 over here and negative 20, here we didn't put any rule. But it actually extends right over here and it actually sees it rejects. So if any negative value appears over here, negative 100,000, it is still rejecting. The color scales are the ones which haven't changed the rules. So please note that. But you can see the color scale on this actually changes. If I want to change the color scale, and we'll be able to have another video for that. So for now, this is where we are. Plus that one minus that value, we're saying we're accepting, sorry, plus that value plus, because it's a negative value there, we're saying it's going to be that. And over here, we said we just take plus, and you see it changes automatically to accept. Here it will change just shortly. Plus, so we come over here, we come to what we're doing, the XNPV. Yes, it's XNPV. We're picking the rate, 8%, like that. Values, over here, we just highlight the values, both negative and positive. Then the dates, we pick the dates there, straightforward like that, no problem at all. We just say okay. So it accepts, you see it changes immediately like that. Moving on, we've made the decision for part 1, A. So now we're moving to A part 2, copy. Now here I just change it to part 2, like that. Highlight the cause of the difference between NPV and XNPV. Explain which one you would use in your analysis and why. So here is just about trying to explain the differences between NPV and XNPV. NPV only considers cash flows over here. So I can maybe, because you're saying that this is going to be the NPV and this is the XNPV, this one is over here. So perhaps I can be able to change this to so it can be able to appear as the NPV component, so that when we move down like this, we just talk about NPV, XNPV like that. So, but we know that this is the present value here. So for now, I can hide this. How do you hide this? You can just come over here and change this to white. Now it doesn't appear there. So in doing presentations, of course, to you know, in the boardroom, you can just hide that on over here, and we can now change over here to NPV like that. NPV. So then here we just delete that. So this relates to rather not that one there. So cut, it should be here. So this is dealing with the NPV and XNPV. Then you center that and you deal with now the NPV and XNPV. So we say for NPV it only does not consider timing of cash flows. NPV does not consider the timing of cash flows. So consider the timing of cash flows there. So I extend it like this a bit, and we move towards the right over here. You can see what I'm talking about over here, sorry. NPV does not consider timing of cash flows. We extend this a bit by double clicking so it can fit, but this one considers. So instead of rewriting it again, we just say come over here and say considers the timing of cash flows. Remember our working, Control V. We come over here, when you see that plus sign where you got two arrows pointing on both sides, you double click. It expands it like that. So you come because of beginning of a sentence, capital, caps. Going back to the question over here, it says highlight the cause of the difference. Timing is about the timing of cash flows. If you want to check if indeed that's the truth, you can just come to the formula over here. You see XNPV returns the net present value for a schedule of cash flows over here. So even if you double click it over here and you say, we come over here and we put in the discount rate as the way it was over here, 8%, like that, and then we come to the values over here, is a series of cash flows that correspond to a schedule of payments in dates. So it factors the timing, guys. So you can see over here, this is what I was actually trying to explain there. Let's compare that with NPV. So we close this dialog box, function argument. Just below it is NPV. It returns the net present value of an investment based on a discount rate and a series of future payments. So we double click that. Is a rate of discount over the length of one period. So we put over here 8%. And now when we click on value 1, value 2, up to 254 payments can actually be done. Income equally spaced in time and occurring at the end of each period. Equally spaced in time. So the spacing must be consistent. Per month, cash flows are coming in per month, per week, or something like that. Now here you can see it's inconsistent right to the left of your screen. Over here you can see what I'm highlighting here. So we just close this function argument over here and we proceed on. Now which one? The second part of A is asking explain which one you would use in your analysis and why. I would use this XNPV right over here. I highlight it in red because it factors in, it does not consider really when the cash flows are actually, it factors in the timing of cash flows, but irregular timing of cash flows is factored in because cash flows can be irregular at some point in time. Take the period of COVID-19, or the COVID 2020, 2020 spilling over to 2021, cash flows could have actually been coming in at different times. So the best model to use is, or evaluation technique to use is XNPV, and the reason is that you will be able to consider irregular cash flows when they occur. So that is it for part A, part 2. We move on to B, just down here. So B, that is asking part 1 that is asking us to calculate the IRR and XIRR of the project and hence determine whether the project is viable. So now we'll do the same. IRR, and on this other side, XIRR. There. So using the IRR, we can just now click on the this formula bar over here, where we can be able to insert the function. We try and search for, or we search for IRR, and we go. It comes directly over there. So we click OK right over here. Which values are we using? So we are going to just highlight all of them there, like that. Once we highlight all of them like that, we are being told to guess any value. So just put any number, 5. It already gives you the answer right over here. Can you see right over here, ladies and gentlemen? Here. Yes, that is the answer. So the IRR will appear right over here, down here. So, okay, 12%. Or we can be able to put it to exact 11.54%. percent is the IRR, and you can be able to see it. It's right here. How about X IRR? We come to the formula bar. We do the same thing. Remember, it didn't give us an option for the dates. Let's see about X IRR. So we search for X IRR. X IRR. We go. It gives us right here. Okay. The values we pick, including the negative cash flows. It now factors in the dates. Just highlight the dates there. We guess any number. Let's put 5 or 7, 8. You can already see the answer is right here. Just say OK. But it's not in percentages, it's decimal form. Format painter. Click on that. Click on there. It gives us 13.58% there. So we can see how straightforward it is to calculate the IRR and the XIRR. Now we move on to the second part of the question. Determine whether the project is viable. We can see the cutoff rate as far as IRR and XIRR is concerned is this 8% over here. Anything above 8% here is what we should be able to accept as far as IRR and XIRR is concerned. So in both cases, we can just put a decision right over here. Of course, I've not put it in the same font, so that if, so plus, if else statement, if what? Now, we come back over here, we're not sure of what we're going to, the logical test. So we come over here, if this value, if what? If that value is greater than, shift greater than 0, we can say 0%. If true, accept. If it's not true, reject. And you just say okay. So we just accept. You drag that conditional, that rule to the right if that value is greater than 0. But are we comparing against 0, guys? No, we are not. We are comparing against 8% right over here. I want you to test your concentration. So the rule should change over here. If it is greater than 8%, if it is 11%, the discount rate over here, and you see I've highlighted it, so it's 8% like that, we should now change it, and you should still accept like that. But here we should change it, or we just drag the formula. Wait for the positive sign, we drag the formula like that. So it picks, you can see now the 8% has been slotted in over here. Those are rules that, of course, you have already learned over there. But now you can make it even a bit interesting by trying to now change the color theme or the color scheme. Conditional formatting, you come over here. Conditional formatting, say a new rule, and you come over here. Cells that contain what? Not between, we scroll down, greater than 8%, 8%. We can say, we can come over here, format, we can say it's green, you can put that green there. Then we say, okay, it's accepting. Then we just move like that. It accepts. How about if it was negative 11%, 11.5%? Negative 11, I have not put a rule for that. It was negative 11% like that, it would reject. But the color scheme should change if I had put conditional formatting for the, for the negative position, or if I negate it. So you get a negative value, this one would change like that. Would you like to see that? Maybe perhaps you look at another video there. So if cells, you can just try one, a new rule, cells that contain, not between, less than 8%. We put 8% like that. Put it over here, we click format. Over here we put red. That, and you will see what is going to happen just right now. So it's rejected, but it has not shown. Did I put the conditional formatting really? Let me just recheck again. Conditional formatting, new rule. Cells that contain cell value not between less than this, sorry. So it tells us reject. If it says reject, yeah, I've known what I've said. Yeah, if it says reject, so color schemes over here, new rule, cells that contain reject or equal to, less than is equal to reject. You can say reject. Over there, we can change the color over here like this to red, like that. We say okay and okay. So it changes like that. So you can see if it's negative, it says reject like that. And if, of course, if I do then the opposite position, if we say I just do the IRR like the way it was before, like that. So plus, so I click FIRR. I just come to IRR over here and say okay. So it was quick the values. So these are the values over here like that. Then I say guess 4% like that. You can see it's 11.54 like that. And sorry, did I select the correct thing? Counter check. It's always good to counter check. So you can see over here the formula bar. This is part of the auditing process. So we're looking at IRRs over here. We're supposed to just remove that value over there, delete, and then it changes. So like that. So you can see the previous position like that, still rejecting, but it keeps on checking like that. As it changes, as this value changes, you can be able to accept like that. So that can be something interesting for maybe say for presentation towards the board or whatever. So the decision, we've made the decision, part one, then hence determine whether the project is viable. We've already done that. It is viable in both cases in terms of the decision. Part two, sorry, open the brackets, part two, that we're saying we're being requested to highlight the cause of the difference between IRR and XIRR, explain which one you'd use. So it's almost similar to this. Copy. Even if it considers the timing of cash flows, it does not consider the irregular timing. This should be irregular timing of cash flows. Irregular timing, irregular timing of cash flows. And this one considers the irregular, considers the irregular timing of cash flows there. So NPV does not consider the timing of cash flows. So now that should be this. I copy this now, and then you change it like that to now IRR. IRR, and that one, you just copy this one. As you move towards the right like this, you can be able to see, copy, come over here, Control V, and you double click this part so that it can be able to fit into that cell properly, like that, and considers this one. IRR does not consider. This one XNPV considers. XNPV. So XNPV. So one thing that we need to change is this. It's not XNPV, it is XIRR. So it's XIRR. That considers the irregular timing of cash flows there. So having discussed that, now let's look at explain which one you'd use in your analysis and why. So I've already given the reason why, the difference between the IRR in this case and the XIRR over here. The two reasons are here. The one that I'd be able to use is the XIRR because it considers the irregular timing of cash flows. And that irregular timing of cash flows usually happens to some businesses. and you know, it's always important to factor that component of the irregularity of the cash flows. So this one should be the most sought after IRR project evaluation technique. Both the IRR, X-IRR and the X-NPV should be the most sought after project evaluation techniques. Having discussed that, ladies and gentlemen, this brings us to the end of this lesson, this question. Hope to see you in other questions under Manifested Publishers. Thank you and God bless you. Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lengwiri and I am a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are answering question 25 of the December 2022 Business and Data Analytics paper. So we have come to the end, or we are going to solve the final question that appeared on the Business and Data Analytics paper, and you can be able to get all of the questions from question 1 through to question 25 on the Manifested Publishers website. Thank you for being with us. So we are being told on question 25 that Farmgate Company Limited produces and sells shovels. The company provides the following data for quantities of shovels produced and the related production cost for the year 2021. So you have been given the months for year 2021 from January through to December, the quantities produced from January through to December, as well as the production costs from January through to December. You are required to determine the variable cost per unit and the total variable costs using the regression analysis. Part B, estimate the total production cost if the following number of units are produced: 100,000 units, 150,000 units, 200,000 units. Include the lower and upper boundaries at 95% confidence interval. Prepare, part C, a chart plotting the predicted Y versus the actual Y from the regression function determined in A above. Interpret your answer. So we can come to the solution or to solve this question towards the right over here. And what I'll do, I'll just copy this information from here, copy, and place it to the right of your screen. Control V. You can see it actually moves to the right over there. So now, for us to run a regression equation, or for us to run a regression model, we need to make some tests. We first of all come to data right over here. So we escape to avoid this copying component. So we escape. You come to data, then you check towards the far right over here to come and check whether there is a data analysis tool pack over here. If there is none, like the way it is in this case, we need then to come to File. You can see it to the left screen, top left. Then we come to Options, right down over here, Options. And then we come to add-ins. These add-ins are the ones that assist accountants, financial analysts, so that they can be able to make work a bit easy for them. So once you click on it, you hold on a bit until a screen like this appears. Then down right over here, you look for Excel add-ins. So if Excel add-ins is not the default, you can be able to then just click on Excel add-ins or this drop-down window and click Excel add-ins, and then you say Go. So this dialog box comes in for add-ins. You can see it right over here, top right. So we add the analysis tool pack. We add the analysis tool pack, and we don't need the analysis tool pack for Visual Basic analysis. Neither do we need Euro currency tools or solver add-in. These are advanced Excel functions that are used to solve complicated scenarios or create different scenarios for accountants and for investment experts. So we say OK, and immediately you can see analysis appears over there on the ribbon. Data analysis. So if you allow me, I can move towards the right so that we can be able to now solve part A. And for consistency, we just say over here should be A shift like that. We have been told to determine the variable cost per unit and the total variable costs using regression analysis. So of course this has been covered in both QA and quantitative analysis and management accounting, of course still under the Manifested Publishers website. You just come and click data analysis. You hold on a bit, and on this dialog box for data analysis you try and search for regression. So I can see it right over here. So you click regression and say okay. This other dialog box appears. So you need to identify the dependent variable and the independent variable. The independent variable the dependent variable, let me start with that, represents the Y value. Then the independent, that's the dependent. The independent is the X. It's not influenced by anything. So the input range for Y, we just come over here and highlight this, or put and click and drag your cell from where you have the 18 million production cost through down over there. And it actually picks, you can see it over, it picks immediately. X range is the quantities produced. Click like that. Now, because we will need the output at some point, like you can be able to see in part, should be in part C down here, you can see, I'm still holding it constant. So in part B here, we are going to estimate the production cost if the following number of units are produced at 100,000, 150, 200,000. Include the lower and upper boundaries at what? At 95% confidence interval. So we come to this dialog box. When we click, we want to see the 95% confidence interval there. And we want the output, or the output of the regression equation, to appear on a new worksheet. We do not want to deal with it over here because it will be able to interfere with our the data that has been selected. So we want it on a new worksheet. If you prefer it on the same worksheet, you provide an output range on, in the worksheet there. Then we can plot line fit plots, whichever you'd find useful to you, to try and be able to predict the future components of the outputs. The outputs now in this case Y, or production levels, production costs. Then you can also click on residuals and you say okay. So on that new worksheet you will be able to see something like this. So this is what we have. The summary output, you will notice one thing. I'll just double click that so that you can be able to expand the values there. So you'll notice these ones do not have, they only have values, they don't have any formulas with them. So it's important that you actually identify and get to understand what the outputs actually mean. R square remains coefficient of determination. It's useful when, especially when looking at multiple variables, multiple linear regression. Then we're also talking about the standard error. Remember standard error of estimates. This is actually, of course, applied in QA. The number of observations is also useful. 12 months there. Now the degrees of freedom have also been provided, and the total degrees of freedom are actually totaling to 11 over there. And now we come to the most important output in the regression, in our regression right over here, the coefficient. And you can see, if you'll allow me to highlight that in our peach color, beige color. This represents the total cost. This one represents the variable cost per unit. So because we have two sheets right over here, this is, we can rename this, you just double click that, original data, put capital O like that. Then here we can just drag it. You drag it. You hold like that and you drag it like that so that it can come after the original data like that. So output. Outputs there. So now we come back. Now we have the output, or outputs. Original data is over here. Trying to answer part A, which is asking us to determine the variable cost per unit and the total variable cost using regression analysis. So we can say the variable cost, cost per unit is here. We'll just put it right over there, and the total, the variable cost per unit and the total fixed cost. This should have actually been total fixed cost, but we still can be able to calculate the total variable costs because we'll just multiply with the number of units produced there. So total variable cost per unit, we just come back to this output of is that on there. So we can just click plus, we pick on this other, pick that value there. See, that's the value. Total variable cost per unit. So we just double click on that and it actually fits there. Now the total variable costs over here is just the variable cost per unit multiplied by the total units produced. So quantities produced in units. So we can just get a sum plus sum, not sum if, as you can see down over here, it's just the sum. Sum of what? So you double click that. What do we want to sum? We want to sum that value from January through to December. Close that. 2340. Total variable costs plus that times that. Get that. Comma format, you just click this one. Alt H, then you put the comma format over here, K. Total variable cost are that one there. That's the total variable cost. So once we have that, we can then move on to the next question. The total fixed cost, if you're being asked perhaps the total fixed cost out from the output, if you're having the total fixed cost, sorry about that, total fixed costs, total fixed costs plus we come to the outputs. This is the total fixed cost over here because it represents the intercept from our equation. There, enter. So then someone might ask, what is the equation? So we can put in the comma format Alt H and we said K. You can see where K is over here, comma format, that total fixed cost. So we can put our equation over here, the equation, just in case you've been asked. So we'll have y is equals to, the usual formula for a straight line is y is equals to a plus bx, like that. So you can put over here a plus bx, that. So which means the a represents the intercept. We can say our y is equals to, our a will be this value, the fixed cost, 3,977,636. I can put 636 because of rounding off, if you allow me, 636 plus b What is our bx? X represents the variable cost to 95 variable cost per unit so b 95 point yeah, just say 95, or you can put 95.17 like that. So that represents our equation there. Y is equals to a plus, rather it should be the other way around. Y is equals to a, which is 39,77,636 plus 95, yes, 95.17 b. X, pardon me, X, like that. That should be the equation. So that now you just adjust the value of X. You adjust X, you see the impact on the value of Y. So this is what we have as part A. Let's move on to part B. B, like that. So we are being asked to estimate the total production cost if the following numbers of units are produced: 100,000 units, 150,000 units, 200,000 units. We already have the equation with us, so it's like we already preempted. All we just need to do is slot in the X value and right over there. So we want to see the output Y when we slot X as 100,000 units, X as 150,000 units, X as 200,000 units. So we are going to use this above equation, which I've highlighted for you in red. So part 1. Then we'll move on to part 2. So we just move it, of course, towards this other side like that, so that it can reflect what we are discussing here. So part 1, part 2, and then part 3 comes down there. Same format, pick format painter. One of the key objectives of financial modeling is presentation. The better it looks, the more attractive it actually is, or how easy it is for you to be able to explain those variables there. So part 1 was asking us 100,000 units. So we have plus this value, isn't it? Because this is the fixed cost. You're just picking that value there, that value. Plus, we need to open the brackets. Why? Because we need to get a product of 95.17 and X. So this value, which is the variable cost per unit, that one, times what? X represents the number of units produced, 100,000. That. Close the brackets, enter. So we get this. Comma format, Alt H K. So we can put the same Alt H K so that it can pick the comma format there. So this is output production cost. So there, 100,000, 150,000, the same. We can drag this there until we get the plus sign like that. We just drag that. The only thing that we just need to do is to hold. It cannot pick because it adjusting the values keep on moving down over here. You can see even the third value there, it keeps on shifting. So what do we do so that we can be able to hold the value constant? So what we do is that we come over here to our formula over here. What do we want to hold constant? We want to hold the blue and the red one constant. So we put dollar signs. $P, $22, 24. $P, $24. And $P, $22. $P, $22. That ensures that it's going to lock like that. So enter. It will give us the same answer, but now in a different format. So when we drag down like this, it's now going to come like that. All we just need to adjust is just the number of units that we need to adjust, or the production cost. Here, we come to the formula bar here. We just change here to how much? To 150,000. Gives us the answer. We come over here, adjust here to 200,000. Comes there. So these are the production costs with the outputs, or the production costs with the units produced at 100,000, 150,000, and 200,000 units. We can then move on here. We have been told to include the lower and upper boundaries at 95% intervals. What does that mean? This level of production represents these ones. Sorry, not like that. I just move this towards this part over here. The production costs, just moved it. So how many units were we producing a year? We're producing 100,000 units. So units produced. So 100,000, 150,000, and 200,000. That. I'll explain why I'm doing this. Put the comma format. That, of course, all through over here, the comma format should be the same. So if these are units produced, then we need to have we need to come up to the outputs right here. So at the lower bound, you can see here, the lower bound here, I'm highlighting so that you can be able to see. 95% lower bound, that's the value. At the upper bound is this one right over here, these two. So we can say that the X component at 95% confidence, the upper bound, we expect our X to be 109. Our X represents the units that are going to vary there. The intercept will be this one. So we move back to the original tab and type fixed cost. These are the units produced. Fixed costs. Then here we can have the variable cost. Like that. Under the base case, so I can move to the right. It will allow me here. The base case, this will be the production cost. I can merge the cells. You come to merge. Let's make it interesting. Alt H. What do we merge with? You can see M right here. M, merge. So we merge this distance M. And do we want to merge and center? Yes, we press C. So it merges the cells. Base case. What was our fixed cost? We come back to this other tab over here, or it's even over here. You can see it. So fixed cost was this component over here, the 3977. Enter, and it was constant like that. So copy. Should just copy that just down there. So it copies, as you can see, it just copies down from there like that. So what you're supposed to do, you just pick this, copy, paste special. What do you want to paste special? Only the values. That it comes. How about the variable cost? The variable cost was the 95.19. So plus, or I just copy it. Copy there. Control V. But you see what happens if you control V, just paste? That's what happens. I was just demonstrating that. So undo. You paste special values, it will appear there. So these are the production costs or the outputs. Done. So we've already, of course, worked with that. We just take the fixed cost, We say $P, $24, which is the blue one over here, the total fixed cost, plus $P, $22, which is this one over here, the variable cost over here, and then we multiply that by 100,000. We can rechange the formula over here, plus we are going by this equation, y is equals to A, which is the intercept, that one, plus we are saying this variable cost times the units produced over here, plus, open the brackets, variable cost times the units produced, close the bracket, press enter. You drag the formula moving down there. But did we put dollar signs? So it is not going to pick. Let's just see what's going to happen. It picks this time round because we are saying it's just going to move concurrently, moving side by side. But if we had picked the values over here like this, it is going to pick values. So this is the base case. Up to there. Just put it to demarcate it like that. Now we type the same, we copy this, headings, copy like that. We move towards the right and type, paste them over here, Control V, so that now we can be able to do what? The upper bound. That's what we've been told. The upper bound is where we go back to the outputs tab. You can see there's the lower bound over here, 95, and the upper bound over here. So we begin with the upper bound. So upper at 95, we copy this, copy. You can say upper bound, it's not like that. Control-V. So 95%, so 95% confidence, like that. Once we've done that, we copy until there. What do? We merge center. Just come over here directly, merge and center like that, and then it will actually expand it and out of it, like that. So what are the units produced? The units produced don't change. The upper bound, or the units produced is this one, sorry. Copy, Control V, it comes there. What was the fixed costs? We move to this, we toggle to this other output. The fixed costs, the upper bound was this, is this one here. It's the intercept. The intercept is the same as the fixed cost. So we just pick this value, copy, come to this other tab, pick the fixed cost there, that. Then, of course, we are supposed to have, we undo that, and then we paste them over here, Control V like that, because the fixed costs are the same. Comma format, come to Format Painter, paste them like that, and you get the fixed costs like that in the same format. How about the variable cost at the upper bound? Upper bound. You come to the Outputs tab, 109. Copy that, toggle back to the original tab, paste them. Control V, you're done. That, you highlight that, Format Painter, done. Then we come to the production cost. The equation is the one that guides us. Our output is driven by A, which is the intercept or the fixed cost, plus the fixed cost, plus what are we multiplying by? We're multiplying with, we're multiplying the variable cost times these units produced, like that. Close the bracket, enter. Then we pick plus sign, highlight it, comes down like that. Comma format, click on that, it comes like that. This is the upper bound. So we can use these borderlines which are thick like that. That one should also have a thick borderline like that, so it can be able to be presentable, as well as this one here. Thick outer bound, upper bound, and thick case. Now the final one we need to move on is the lower bound. So we just copy this, but we'll just change it. Control V. Don't repeat the upper bound. Now we put lower bound, lower. lower bound, 95%. Put capital L. They're like that. Then we copy these headings, Control V, that. We copy these units produced, copy, put them here. Then the fixed cost. How much of the fixed cost? This time is the lower bound. Toggle back to outputs. We're looking at this value. Copy. We come back to toggle back over here. So the fixed cost is that one there, Control V. I should have, pardon me for that. Should highlight all of this section, Control V. Then the variable cost. Toggle back. The variable cost is that one. Copy original. Highlight the 3 sections there, Control V, you're done. Then what you do is that you highlight or you just put it in a similar format. So what you do, just highlight any of them over here like that. You format painter, use that until there so it can pick everything. You're done. Then finally, we are saying that we need to get the production cost outside here. So the production cost should have the thick kind of border. Then what we'll be able to do is just pick, based on the equation, guys, the equation is the one that is guiding us. Y is equals to A plus BX. So Y on this side, Y is equals to A, which represents our intercept fixed cost, A plus, open the brackets, variable cost times units produced. Close the brackets, enter. We come and highlight, put it down like that. Those are the values that we get. So now the production costs, I'll highlight them in red so that you can be able to just visibly see the difference between, or just identify the changes in the production costs at different levels or at different fixed costs like that. So what I can do is that you can see under the base case, the production cost is 13 at 100,000. It increases to 18 and 23,000. It changes for the upper bound to 17, from 13 to 17, and from 18 to 23, 23 to 28. How about the lower bound? It changes from 13 to 9, the lower level, the lower boundary, from 18 to 13, and 23 to 17. The reason, ladies and gentlemen, we are creating the base case, or these scenarios, the base case, the upper bound, and towards the right over here, the lower bound, is because the question was asking us to estimate the total production cost based on this equation as it is, or the current scenario over here, where we have Y is equals to A plus BX, which is A represents the fixed cost plus variable cost times X over there for the base case, and we've actually done the computation over here. From the outputs, we got this as the variable cost and this as the fixed cost. You can see them as I toggle back and right over here. So this was the variable cost. You can even see it's indicated here, variable 1, variable cost, and this is the intercept, which represents the fixed cost over here. Toggling back to the original, we needed then to have the lower and upper boundaries at 95% confidence intervals. What are the outputs at the lower and upper boundaries? The outputs, toggle back over here, you can see lower bound, this is the fixed cost over here, and this is the variable cost per unit. For the upper bound, this is the fixed cost, and this is the variable cost per unit. Those two, what we've done is that we have then created, and we toggle back over here, the scenarios for the upper bound here. The units produced are the same, but the fixed cost under the upper bound changes. The variable cost also changes over here, as we've seen when toggling back to the outputs. Then we see what impact it has towards the production cost. The units produced for the lower bound are the same. The fixed cost changes now for the lower bound, the lower boundary. The variable costs also change as per the outputs. Toggle back over there, and the production costs are provided over here. Following which equation? The equation for a straight line, which you are saying is a plus bx, and this was there for the base case. For the upper bound would be, now you'd be able to apply the fixed cost and the variable cost as appropriate in the equation. Having discussed part B, let's move on and discuss part C. Prepare a chart plotting predicted y versus the actual y from regression function determined in A above. Interpret your answer. So moving towards the right over here, you can see we have this is our y right over here. So we will be able to just copy this table over here. We need the table over here, copy. We come just down here. We first of all label that this is part C. This is part C over here. C. We paste the table right down here. Control V. So it didn't pick Control V, so I have to copy again. Sometimes it refuses. So copy. Come down here, Control V, and you see it's there. Based on what we need from the question, we only need to plot the predicted y versus the actual y. So we don't need our x values here. So what do? Just pick that, highlight, delete. Delete, you can see delete here. You delete. Where do you want to delete? We're deleting to the left. So that goes. And you see these values remain over here. So this one we can rename it as actual y. Actual y, like that, which is the production cost. Put it capital. Like that. Now predicted y will be over here. Predicted y. In fact, it is actually under the outputs. How do we get the predicted y? From the outputs that we developed in part A. So we toggle back to the outputs. Where are the outputs? So we've dealt with that part over here, and we can clearly see that there are 12 observations over here for 12 months, and the predicted y's are actually right over here. So we just copy these values, that, copy, and we toggle back to the original, and we paste them down over here. Control V, like that. Not in a similar format, no problem. We just highlight that one over here, and Format Painter, put it back over here for presentation purposes, like that, and we can see. So both of them are production costs, yes, but this is the actual y, and this is the predicted y. Now how do we plot a graph? Escape. We just come over here, we highlight the data that we need, like that, and then we come to insert there, and we can see the charts over here. We do not want a scatter. No, we don't want that. We want at least a line graph over there. And so what kind of line graph do we want? Our line graph should actually appear either if you want points like that, or if you want it to be like that. It depends on what you actually want it to look like. So may I prefer this one, like this. It shows the months, and you can be able to clearly see that it shows the months over here, it shows the production levels over here, it shows the actual y and the predicted y values over here. So we can push this towards the right over here of this table over here, and we rename the chart title. We give it a chart title over here, and production costs. Production, it's not writing, I just cancel that. Production cost, costs, like that. And in trying to answer, you can even change the type of graph that you actually want over here. So this is over here, if you want a black graph over here, it depends on what you'd actually prefer to actually use. So you just change the type of graph that shows, that better suits maybe your presentation, because you're going to use also PDF, rather PowerPoint, to also try and make the graph very attractive for presentation purposes. So we leave it like that, and we can interpret, because you're being requested to interpret your answer. Indeed, we are saying that the actual values of y, which is represented by the blue line, actually move in tandem or in a similar fashion as the predicted values of y. So the model itself is useful in predicting future production costs. That is simply the interpretation, that the model is useful in predicting future production costs as you move ahead. So this is a useful tool for analysts or for accountants to try and test, of just to audit in some cases, to audit the model and try and see whether it actually will release consistent results. So ladies and gentlemen, this brings us to the end of December 2022 Business and Data Analytics. We hope that you have enjoyed the paper. Thank you and God bless you.
Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, you are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1, describe 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings? Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate, in carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. Inspection of buildings documentation. You understand? That is if the building was bought. then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings, whether the buildings were bought or even constructed by the company. There are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The fourth audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector, and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? And what are the standards, what are the norms in the industry compared to what the company is doing? Because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. Communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with third parties. Industry experts. So these are some of the audit procedures. They are not the only audit procedures. There are more. There could be more, but these are 6 audit procedures that the auditor can perform in relation to the buildings of Miradi Limited Company, which has not been providing for depreciation on buildings for the last 3 years. So the auditor here, I'm saying, should seek validation or additional insights to support audit findings. So these additional procedures candidates aim to enhance the auditor's understanding of the depreciation matter. These audit procedures may also help the auditor assess the impact of the decision not to provide for depreciation on the financial statements, and also to ensure compliance with accounting standards and regulatory requirements. That is the solution to that part. Additional audit procedures: number 1, review accounting policies. Number 2, assessment of depreciation methodology. Number 3, inspection of buildings documentation. Number 4, evaluation of maintenance expenditures. Number 5, a comparison with industry standards. Then lastly, communication with third parties. That is part A, Roman 1. A, Roman 2, assume that according to your workings, the depreciation charge on buildings for the year ended 30th June 2023 should be 4.2 million based on the straight line method of depreciation at an annual rate of 5%. Required, discuss the implications of the above on the financial statements, clearly indicating its effect on the audit report. This is Roman 2. We have to discuss implications of the above on the financial statements. The above is assuming, according to your workings, the depreciation charge on the buildings for the year ended 30 June 2023 should be 4.2 million on the straight line method depreciation at an annual rate of 5%. What is the implication of this? What is the implication if the depreciation was to be 4.2 million? What is the implication on the financial statements? This question is in 2 parts. Implication on the financial statements, then clearly indicating its effect on the audit report. We'll also discuss the effect of this information on the audit report. But first of all, let us discuss implications on the financial statements. Failure to provide for depreciation on buildings, despite being required by accounting standards candidates, has several implications on the financial statements and consequently on the audit report. So what are these implications on the financial statement. The first implication is overstatement of assets. Overstatement of assets. Now, since depreciation represents the systematic allocation of the cost of an asset over its useful life, not recognizing depreciation results in overstatement of the carrying amount of buildings on the balance sheet. And in that case, the building's value would remain at their original acquisition cost, leading to an inflated asset value. So ideally, depreciation is to reduce the cost of the building. But if depreciation is not charged, then the assets will be overstated. The asset will be overstated. We read from this question that the company has a net asset of 150 million. This is a total value of assets. That tells you that the value of 150 million is overstated because of the fact that the company does not provide for depreciation. And if this company has not been providing for depreciation for the last 3 years, and we have read in note number 2 that the depreciation charge, the auditor may have carried out this depreciation to be 4.2 per annum. If the depreciation charge is 4.2 per annum, and this company has not provided for depreciation for the last 3 years, you can see, candidates, the depreciation charge, the accumulated depreciation is 12.6 million. So that means that the total value of assets, the net assets of 150 million is overstated by 12.6 million. That is the implication of not providing for depreciation on assets by this company. That's the first implication. The second implication is the overstatement of net income. The net income is overstated as well, because depreciation expense is deducted from revenue to calculate net income. And by not recognizing depreciation, the company's reported net income would be higher than it should be. And in this scenario, the absence of depreciation charge of 4.2 million would lead to the overstatement of net income, thereby distorting the profitability of the company. So for example, if the company recorded a net profit for this year of, say, 30 million, that means that that net profit is overstated by 4.2 million. So that is the impact of not providing for depreciation on buildings. Number 3, distorted financial ratios. Distorted financial ratios. Now, the overstatement of assets and net income due to the omission of depreciation affects various financial ratios. For example, the return on assets ratio would be inflated, giving a false impression of the company's efficiency in generating profits from assets. Similarly, the debt to equity ratio could also be affected, as the inflated assets would lead to a lower leverage ratio. You may have other assets like the return on capital or return on capital employed, which is calculated by getting the ratio between the net profit and sales, or net profit and return on capital employed. So the omission to depreciate buildings could lead to distorted financial ratios. Why? Because the assets are inflated, net income is also inflated, and that could affect various financial ratios. That is an implication of not providing for depreciation on buildings. for misrepresentation of the financial position of the company, of the financial position of the company. Misrepresentation of the financial position of the company. Financial statements are meant to provide a true and fair view of a company's financial position. So failing to recognize depreciation results in misrepresentation of the company's true financial position by overstating assets and overstating profitability. And these misrepresentation candidates could mislead stakeholders, including investors, creditors, and even the regulators. So that is the fourth impact for not providing for depreciation on buildings. The question required candidates also to highlight the effect of this omission on the audit report. If I can take the question again, discuss the implications of the above on the financial statements. So these are the impacts on the financial statements, clearly indicating its impact on the audit report. Impact on audit report. What is the impact of this omission on audit report? Impact on audit report. Now, the auditor would need to issue a qualified or adverse opinion. The auditor may need to issue a qualified or adverse opinion. As a result of these effects of omission of depreciation of buildings on buildings, as a result of these effects or this omission of depreciating buildings has effect or impact on the audit report. One impact is that may lead to issuance of a qualified or adverse opinion. And that whether the auditor issues a qualified or adverse opinion depends on the materiality or the pervasiveness of the issue. And candidates here, a qualified opinion would be issued if the auditor concludes that the failure to recognize depreciation results in a material misstatement of the financial statements, but is not pervasive. On the other hand, an adverse opinion would be warranted if the auditor determines that the misstatement is both material and pervasive, meaning that it affects multiple areas of the financial statements. So that would be one impact. That may lead to issuance of a qualified opinion or adverse opinion depending on the materiality of and pervasiveness of the error. The audit report number 2 may also include a section discussing the basis for qualification or adverse opinion. There would be an additional paragraph. The audit report would contain a section. You understand? Discussing the basis for qualification or for issuing an adverse opinion. And this section would explain the reasons for the auditor's conclusion, including the failure to recognize depreciation, including the impacts of this omission to depreciate buildings on the financial statements. It would also highlight the departure from accounting standards and regulatory requirements. Additional paragraph. There will be a section explaining the impact of this mistake on the and so on. So these are two impacts on the audit report. Now, candidates, in concluding this part of the question, we can say that the failure to recognize depreciation on building has significant implications for accuracy and reliability of the financial statements, requiring appropriate disclosure and also qualification in the audit report in order to inform the stakeholders of the limitations of the financial information that has been presented. So the auditor has a duty to inform the users of the financial statements of the failure by the management to depreciate buildings. Failure to recognize depreciation on buildings has significant implications for the accuracy and reliability of the financial statements. We've seen how the failure of this failure can lead to implication on the assets. It has implications on the net income. It has implications on financial ratios. It has also implication on the truthfulness and the fairness of the financial statements, because we know that financial statements are expected to portray a true and fair view. But if there is an omission in depreciation, that can lead to misrepresentation of the financial position, which means that the financial position of the company as presented by the management does not present a true and fair view. So that is question A, part 2 had 8 marks. 1, 2, 3, 4, 5, 6. Any 4 points there would earn you 8 marks. Part B, audit risks associated with audit of financial statements. Now, candidates, financial instruments, we all know, present unique challenges for auditors due to their complexity and due to their inherent risks. So what are some of the audit risks that are associated with the audit of financial statements? So if you are to audit financial statements, what are some of the risks that are associated with audit of the financial instruments? Not statements, but instruments. Audit risks associated with audit of financial instruments. The first audit risk is the valuation risk. Valuation risk. Now, financial instruments are often valued using their fair value estimates, which can be subjective and prone to error. So auditors need to assess the appropriateness of valuation techniques, and the auditors also may need to assess the underlying assumptions used by the management. So when auditing financial instruments, the auditors must pay attention to the appropriateness of the valuation techniques and also the underlying assumptions that were used by the management to value the financial instruments. So valuation risk is an audit risk associated with the audit of financial instruments. 2, model risk. Model risk. Now, complex valuation models are sometimes used to determine fair value. And these models can be flawed or can contain errors leading to misstated financial instruments or even misstated financial statements. So auditors need to evaluate the control around model development and their use. So financial instruments are valued based on certain models. So there could also be errors in the development of these models, which can pose model risks. And when auditing these financial instruments, the auditors ought to pay attention to the models and the risks and how they are developed. There are also inherent risks associated with the audit of financial instruments. Number 3, inherent risks. Financial instruments are inherently risky due to factors like market fluctuations, factors like creditworthiness of the counterparts, and also liquidity issues. So the inherent risk associated with the specific instrument can be high, requiring extensive audit procedures. Inherent risks. 4, control risks. There are also control risks associated with the audit of financial instruments. The internal controls surrounding financial instruments may be weak, they may be ineffective, and that could allow for errors or fraud to go undetected. So auditors need to assess the design and also the operating effectiveness of controls related to financial instruments and also related to transactions around financial instruments and valuation. Control risks. Lastly, we have classification risk. There's also risk associated with classification. Financial instruments can be complex and may be incorrectly classified in the financial statements. And this misclassification can have a significant impact on the reported financial position and results. So auditors need to understand the classification criteria, and also they need to test the company's classification processes. Classification risks. There's also disclosure risk associated with the audit of financial instruments. Disclosure risk. The financial statements may not adequately disclose the nature and the extent of the risk associated with financial instruments. And insufficient disclosures candidates can mislead users of the financial statements. So auditors need to assess the completeness and the accuracy of disclosures related to financial instruments, like derivatives. So these are 6 audit risks. Candidates were to give 6 audit risks. 1 is valuation risk, 2 model risk, 3 inherent risk, 4 control risk, 5 classification risk, 6 disclosure risk. How many marks? These are 6 marks. 6 marks. Part A of the question, how many marks? This one, 6, this a point here, 6 marks. Then we have 6 part 2, implication on financial statements, 6 marks. These are 8 marks. Any 4 points will earn you 8 marks here. Total is 20 marks. So that is a suggested solution to the Advanced Auditing and Assurance December 2022 question 1. Thank you for attending the lesson. In our next session, we are going to answer question number 2. So please attempt question number 2 before joining our next session. Bye-bye. Hello everyone, and welcome back to the revision of the Advanced Auditing and Assurance paper that was done in December 2023. We, in our last lesson, did question 1. Today, we move on to question number 2. Part A of this question reads, the following is an extract from a speech presented in a recent professional forum. First paragraph reads, in the private sector, going concern is an area of interest to users of financial statements. Shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. Paragraph 2. The going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or national funds, have a statutory existence that makes technical insolvency almost impossible. Lastly, the last paragraph, despite that, stakeholders in the public sector still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. So we've read that in the private sector, going concern is an area of interest to users of financial statements, and shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. The second paragraph says that the going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or even national funds, have a statutory existence that makes technical insolvency almost impossible. Despite that, shareholders or stakeholders in the public sector will still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. Now, candidates, while technical insolvency may be less likely in public entities, their going concern can still be impacted. So the question is, what are some of the factors that an auditor should consider when assessing the going concern assumption for public bodies? That is the question we are going to answer first. Part A. Factors that an auditor should consider in determining the going concern assumption. Now, the first factor to consider is government funding. The government funding reliance. Government funding reliance. What does that mean? That means that the entity's dependence on government funding and stability of such funding plays a key role. And significant funding cuts or uncertainties can threaten the ability to continue in operation. So when determining whether a public entity will continue operating in the foreseeable future, to determine the going concern assumption of a public entity, the auditor should check government funding reliance, such that if there is significant funding cuts for a given public entity or department, then that department is likely not to continue in operating in the foreseeable future. Do you understand? Government funding, because without funding, organizations or departments cannot operate. So the going concern may be threatened for an organization or a department or an entity of government where there are significant funding cuts. 2, financial sustainability. The auditor can consider financial sustainability. The auditor should assess the entity's long-term financial position, including operating margins, debt levels, and also cash flow, because unsustainable financial practices or inability to generate sufficient revenue may raise concerns or may affect the going concern of such an entity. Financial sustainability ought to be considered by an auditor when determining the going concern of an entity. 3, legislative changes. Legislative or regulatory changes. Changes in laws, changes in regulations should be considered. These are potential changes in laws, regulations, changes in accounting standards should be considered. These are changes that may impact the entity's operations or funding, and therefore unexpected changes can disrupt financial stability of a government entity. 4, public policy priorities. Public policy priorities. The auditor should analyze how changes in government priorities or public policies may affect the entity's funding or mandate, because shifting priorities could lead to reduced resource allocation, jeopardizing operations of a government department or institution. Public policy priorities can be considered when determining the going concern assumption in the public sector. 5, the economic environment, the social environment should be considered. Economic and social environment. Economic and social environment. The auditor ought to assess the impact of the broader economic and also social factors like economic downturns, social unrest, natural disasters, which can disrupt operations and reduce demand for services that are offered by a given public sector entity. 5 or 6, this is 6, operational efficiency and effectiveness. How effective is the entity? How efficient is the entity? Operational efficiency and effectiveness. The auditor ought to evaluate the entity's efficiency in using resources and achieving its objectives, because inefficiencies or failure to deliver on mandates can affect public support and future funding. So if an auditor is to determine the going concern of a given public sector entity, then he may, or the auditors may have to evaluate how the entity utilizes resources. So if there are wastages and inefficiencies, or if the entity fails to deliver on mandate, then that can affect future funding. Operational efficiency and operational effectiveness. 7, management plans and strategies. What are the strategies of the public sector entity, what are the strategies, what are the plans, does the organization have plans, does it have strategies that should be considered. The auditor should analyze the entity's plans to address financial challenges, the plans to improve efficiency, or even to adapt to changing circumstances. Because robust and credible plans can mitigate the going concerns, the concerns of going concern. You understand? Management plans and strategies ought to be evaluated by the auditor. 8. Public confidence. Does the public have confidence in the public sector entity or even stakeholder confidence and, let me say, and stakeholder support? Public confidence and stakeholder support. The auditor ought to check or consider the level of public trust and support for the entity, as it can influence future funding and political will to sustain the operations of such an entity. You understand? Because candidates, a loss of public confidence can impact budget allocations, can also impact legislative priorities. Okay? So these are 8 factors an auditor should consider in determining the going concern assumption in the public sector. So these factors highlight that although public entities have statutory protection, their going concern is not guaranteed. As much as there is a law in place that upon which public sector entities and departments are formed, that is not a guarantee that the public sector entity will continue operating in the foreseeable future. And auditors must thoroughly assess their financial sustainability, must assess the external environment, must assess the future plans that the organization has, provide an informed decision so that the auditors can provide an informed opinion on the ability of the entities to continue as a going concern. So these are 8 factors. 1, government funding reliance. 2, financial sustainability. 3, legislative and regulatory changes. 4, public policy priorities. 5, economic and social environment. 6, operational efficiency and effectiveness. 7, management plans and strategies. 8, public confidence and stakeholder support. So all these factors can affect the going concern of any public sector entity. And therefore, when the auditor is carrying out his or her audit, he must consider these factors in determining whether an entity is a going concern or not. That is question 2A. Question 2B reads, describe 4 procedures that an auditor might perform to identify subsequent events occurring after the financial year end in a company. Procedures an auditor should perform. What are the procedures for identifying subsequent event? What should the auditor do to identify subsequent event? What are the procedures? 1 is to inquire from management. Inquiry, right? Inquiry of management. This means just talking to the management, asking questions. Ask questions regarding subsequent events, because managers are the ones who are in charge with the operations of an organization. So if an auditor would want to identify subsequent events, then it becomes obvious talk to the management, discuss with the management whether any significant events occurred after the reporting date that may affect the financial statements. Why? Because the management has a responsibility to disclose such events. Discuss with the management, ask questions, inquire, are there any subsequent events? So that is a procedure an auditor can perform to identify subsequent events. 2 is review of external sources. Review of external sources. The auditor can monitor news articles, industry publications, regulatory filings for any events impacting the entity or its sector after the reporting date. Review external sources, publications, newspapers, social media, industry publications, regulatory filings. That is one way to identify subsequent events. If the auditor does not get the information from the management, then he can seek for the same information from external sources. Performance of analytical procedures. Performance of analytical procedures. That's another procedure that an auditor can perform to identify subsequent events. This is the auditor can perform analytical procedures by comparing the key financial ratios to identify any trends with to identify the trends with prior periods. The auditor can also perform or can also compare the company's financial ratios with industry benchmark. And any unexpected changes between industry, between the financial ratios of the company and the benchmark, the industry benchmark, or between the company and previous periods, any unexpected ratios could indicate the occurrence of subsequent events. Perform analytical procedures. 4. Follow up audit procedures. Follow-up audit procedures. The auditor can perform additional audit procedures specific to areas that are identified as risky or areas that have a potential for subsequent events. And that may involve rechecking accounts receivables or confirming bank balances, accounts payables, and so on. So these are 4 audit procedures that the auditor can perform in order to identify subsequent events. And by implementing these procedures, auditors can identify and appropriately address subsequent events that may affect the accuracy and the completeness of the as well as the reliability of the financial statements. 4 procedures, 8 marks. 1, 2, 3, 4, 8 marks. That is part B of the question. Part C reads, your audit firm KKCOL LP has been the auditor of Express Limited, a leading online retailer that was established a few years ago. At inception, the company had an average delivery time of a week, but has since grown to an average delivery time of between 1 and 5 days. The company started with 3 employees and has grown to 1,000 employees, including 150 customer service team who are available 7 days a week. It has emerged that an employee stole 20 million shillings by manipulating vendor payment records, pointing to the risk of fraud facing their trading platforms. Required, prepare a proposal to the directors of Express Limited explaining Roman 1, the need for an internal audit function in the company. Roman 2, the benefits of outsourcing the internal audit function. So you are to prepare a proposal, and the basis of the proposal is 1, the need for an internal audit function in the company, and the benefits of outsourcing the internal audit function. So this is a proposal from the auditor to the company, which is known as the Express Limited. All right. Part C required candidates to prepare a proposal for establishing an internal audit function. Prepare a proposal to the auditors explaining the need for an internal audit function in the company and the benefits. So the proposal is this is a proposal to Express Limited. Then you can have the address there. So this proposal is to the Express Limited, and it is from the auditors. These are auditors. The name of the auditors, KKCO LLP. Then you have the address. Proposal to Express Limited from KKCO LLP. These are auditors. You understand, candidates? Then you may have the date there. The date. Because we have dates. The date. You can have the date, any date, teacher's date. Then you have the subject, which you can say establishment of the audit function. Establishment of the audit function. Establishment of internal audit function should be internal audit function. Let me have it. Establishment of internal audit function. That's the subject of the proposal. Establishment of an internal audit function. Then candidates, we may have 3 sections or 2 sections within this proposal. We may have an executive summary, but looking at the marks, candidates, this is for knowledge, but an executive summary may not be a must. What is important in this proposal is to capture the need for an audit function and the benefits of outsourcing the internal audit function. So you may have an executive summary where you highlight the problem that the company has had, because we've read that the Express Limited has experienced phenomenal growth in the recent past. It has experienced phenomenal growth. We read that the company initially had how many employees? The company started with 3 employees and has grown to 1,000 employees. So the company has experienced phenomenal growth in the recent years, expanding its workforce, expanding services. You can see, including 150 customer service team who are available 7 days a week. So that could be the introduction to this proposal, that the company has experienced phenomenal or substantial or significant growth in recent past, expanding its workforce, services, and delivery capabilities. We've seen it delivers within 7 days a week. And because of this rapid growth, we can say this rapid growth presents new opportunities and challenges, particularly regarding the internal audit function within Express Limited, to address the evolving needs and safeguard the company's financial health and operational efficiency. So that could be what you can write under the executive summary. You summarize the problem. Then another part of this could be what is required in the question, which is the need for an internal audit function. So you can write the need for an internal audit function. That's another part of the proposal, the need for an internal audit function. Now, candidates, as Express Limited scales, relying solely on external audits is insufficient. As the company scales, as the company significantly grows, then relying on the external audit function is not sufficient, and therefore an internal audit function offers invaluable benefits. So what are the benefits? What is the need? Why should the company establish an internal audit function? That's the question. The need for an internal audit function. The first reason why the company needs